All right, is everybody ready to get started? You're all set? Okay, look, we're on the record. I call cases 13-E-0030, 13-G-0031, and 13-S-0032. These are the Con Edison electric, gas, and steam rate cases that were filed in January of this year. My name is Administrative Law Judge Paul Agresta. With me today is Administrative Law Judge Julia Smead-Bilowski, and we'll be presiding over the hearings. We will be joined later in the week by Judge Stein as well. This hearing is pursuant to a notice of evidentiary hearing issued on June 27, 2013. At this time, I'd like to take appearances, starting with Con Edison and staff.
Morning, Your Honors. My name is Mark Richter on behalf of Consolidated Edison Company of New York, Inc. I'd like to enter the appearance of a number of other Con Edison attorneys who will or may participate in the hearing over the course of the next 2 weeks. I do have a card for each one to hand to the court reporter, so there'll be no issue in terms of the spelling of their names. Inver Acevedo, John Carley, Anna Chakow, Martin Heslin, Kerry Ann Kirschbaum, Mary Krajewski, Don Riazzi, Daniel Rosenblum, Don Stauber, Susan Burchick, and David Warner.
Thank you. For staff.
Good morning, Your Honors. Alan Michaels for staff.
Brandon Goodrich for staff.
Brian Osius for staff.
Don Gazzo for staff.
Your Honors, in lieu of an appearance of Stephen Kramer, our colleague and friend who's in Albany on a family emergency, my name is Dakin, D-A-K-I-N, Leakakes, L-E-C-A-K-E-S, and I've been recently substituted onto the case.
Thank you. Okay, now we're going to go around the room to the other parties. So let's go ahead.
Stuart Glass and Mia Holman on behalf of Assemblywoman Amy Paulin.
Lisa Kwong on behalf of the New York State Attorney General's Office.
Charlie Donaldson, also from the AG's office.
Christopher Nzero on behalf of the County of Westchester Law Department. Also wanted to announce a few attorneys representing us through our retained counsel through Duncan, Weinberg, Genzer, and Penbrook. Those attorneys are Jason Gray, Ms. Bavita Modi, Jeffrey Genzer, and Tom Rudabush, and business cards will also be provided to the court reporters for their names.
Thank you.
Saul Rigberg for the Utility Intervention Unit of the New York Department of State. With me is Tim Creel.
George Demontopoulos for the law firm of C. Hansen and Nelson Peterson, appearing for the New York Energy Consumers Council.
Gary Levinson for the New York Power Authority. Also on energy appearances of Andrew Newman, is N-E-U-M-A-N, and David Applebaum, A-P-P-E-L-B-A-U-M.
Good morning, Your Honors. On behalf of the City of New York, Kevin Lang from the law firm of Couch White. I'd also like to enter the appearances of Michael Delaney on behalf of the city, and also with Couch White, Robert Lockney, Adam Conway, Amanda DeVito, Jay Goodman, and Michael Nager. And we'll get business cards for each of them for you.
Thank you.
Good morning. David Johnson from the law firm of Reed Onyado for Astoria Generating Company, LP.
Are there any other parties caring to make an appearance?
Good morning, Your Honor. Leonard Lucas on behalf of the General Service Administration.
Thank you. Anybody else?
Andrea Serban on behalf of Pace Energy and Climate Center.
Ann Siders, and from Andrew Carr from the Columbia City Climate Change Law.
Elizabeth Stein on behalf of the Variable Defense Fund, and my colleagues Jim Tripp and Adam Helms will be here from Evidentiary.
Anybody else? Okay. Let's do a couple of administrative matters. There is a witness for tomorrow, Mr. Bomke, and based on my current records, nobody has any cross for him. So is that correct? Does anybody have any cross for Mr. Bomke? As of now, I've had everybody who said they were going to cross him has said that they're withdrawn.
Your Honor, none for tomorrow. I think he's scheduled for sometime next week, but we still have some time reserved. His name was in a number of places, but none for tomorrow.
Hopefully staff have any cross as well.
Okay, so that witness will be excused for tomorrow. And I think he was going to appear 3 times. He's the only person who's sort of spread around on here. But I don't see his third date on here yet.
George Demontopoulos, Fenways is here. I believe Mr. Bomke is scheduled for next Wednesday. It's on the bottom of the page.
Okay, and I do see about 25 minutes across for that testimony. So the first 2 sets of his testimony will go in by affidavit. If you could supply an original affidavit to me, you can send it by mail to Albany.
Oh, okay. Can we do that on next Wednesday?
You could bring it next Wednesday. Okay. All right. I've been told that our microphones are plugged into the floor, and that if you kick the thing where the microphone goes into the floor, you're going to wipe out yourself and a couple of your neighbors. So please be aware of where your feet are. Also, anyone who's wearing a suit jacket and would like to take it off, please take it off. It's very hot in here. Okay. I think at some point later in the day, we're going to talk about the list of exhibits. So parties could be prepared perhaps after the lunch break to the ones who had identified exhibits that were missing from the list that I circulated. I also want to mention that we're going to do something a little different than the ruling is centered around on procedure. As a streamlining and paper-saving measure, we've decided that the pre-filed testimony, which is already in the DMM system, that's the Commission's electronic record system, we are not going to take those pages and then insert them in the transcript when the witness is called. Instead, we're going to rely on the document that's already in the computer system for briefing purposes. So ordinarily in the old days, you would hand up your testimony, your pre-filed testimony, and the court reporter would copy it and put it into the transcript at that point. Instead, we're going to issue a ruling after the hearings are over saying which testimony is considered part of the transcript. And the transcript you get will only be the actual oral proceedings that go on here in this room. Okay? We think that's going to save thousands of pages of paper, and it's going to make everybody's life easier. The difference is that when you write your brief, instead of citing to transcript page whatever, you'll be citing to the testimony and whatever page is on that testimony already. But again, that's probably going to save you time too, because now you don't have to convert the testimony page into a transcript page after you get the transcript. So we're hoping that everybody's going to welcome these changes. That's all the preliminary matters I have at this time. Is there anybody else who wants to raise a preliminary matter before we get into the hearings? Yes, come to a microphone, please. And you give your name. Whenever you're going to talk, if you could just give your last name so that the reporter will have some idea who you are.
Maybe, you may have already ruled on this, but I didn't see it. Is there a procedure for submitting into evidence the interrogatory responses?
The normal procedure is to ask the witness if they had made those responses, and if they say yes, then you ask that they be marked for exhibit.
Okay, and if the witness is not being crossed, what would the process be?
I'm open to a procedure where you do that, but you probably should have put the witness down for cross, if that was what you were planning on doing.
Well, I put the witness down for cross, but then I released them. But I have an agreement from Con Edison that they did not object to the submission of the interrogatory responses to the crime.
Okay. Then after we take a break and we get into exhibits, maybe you could propose that they be marked at that time. Would you be prepared to do that today? Do you know which ones they are? And do you have copies of them?
Not today. I could do that on Wednesday.
Why don't you send them by email as soon as you can, along with a request that they be marked and admitted. Okay. I don't need a formal written motion other than an email, sort of an email motion. Okay. And then other parties will have an opportunity to object when we get to the objection to testimony and exhibits at the end of the hearings. Okay. If anybody else is in that same boat, and they have similar agreements with the witness whose interrogatory it was, I don't have a problem with them following the procedure. But we're going to want all these exhibits in as soon as you can get them to us, and not after the hearings are closed. Any other preliminary matters? Okay, then let's call the first set of witnesses. We have the Con Ed Electric Property Tax Depreciation Panel.
Thomas Riazzi. The company calls its property tax depreciation panel. Your Honors, while they're assembling, one member of the panel is not present. I have an affidavit from that member. Would you like to provide it now or some other way?
Could you speak up a little bit? I don't know if your microphone's not connected.
One member of the panel is not present. I have an affidavit from that member of the panel, which would like to be submitted at this time or some other time.
I'll take it at this time.
One or two hours. You guys are working.
Okay, Con Edison has proposed that the pre-filed testimony of Stephanie Merritt be accepted by affidavit, but that the remainder of the panel will be available to answer any questions that would have been answered by that witness. Is that correct?
Yes.
Okay, and you've submitted an affidavit, which is the original, which I've marked as Exhibit 757 for identification. Does any party want to be heard on this matter, or should we proceed? Okay, hearing none, we're going to proceed. Now, witnesses, you have somewhere on that table, I believe, a magic marker and some paper. And if you could quickly just jot down your last name. Is it on there? Yeah. If you could quickly jot down your names and put them in front of you so that we can have some idea as to who you are. And for the other witnesses that are on deck, if you could come up and get a piece of paper and write your name in advance before you get up there, it would speed things along a little bit. Now, is this just the electric panel, or is it the electric, gas, and steam panels together?
All three.
All three together? Okay. And the testimonies are all dated January 25th, is that right?
I believe so.
And we don't have any other testimony from these panelists?
There's updated rebuttal testimonies.
Okay, there's a rebuttal testimony dated 6/21, and that's for all three of the panels, right?
All cases, yes.
Yeah, okay.
Can folks please speak up a little more?
Okay, so this panel is being crossed on 4 sets of testimony, and it's all on that master list that's been previously circulated to the parties. All right, so now we're going to swear in the witnesses.
Raise your right hand, please. I'm going to ask you 2 questions, okay? But we can have you all answer at once. We'll just do it collectively. Do you swear or affirm that the testimony you are about to give will be the truth, the whole truth, and nothing but the truth?
Yes.
Do you adopt your pre-filed testimony as your sworn testimony in these proceedings?
Yes. Excuse me, one preliminary question. Do you have any
I can't hear you at all. Is there? Can you turn that towards your?
One preliminary question for the witnesses, please. Do you have any substantive corrections to your testimony? Yes?
On page 30 of our update and rebuttal testimony, on lines 11 and 12, we refer to a steam department depreciation reserve deficiency in the amount of $388 million. The correct amount is $38.8 million.
With that, Your Honor, the panel is available for cross-examination.
Thank you. Okay, I see cross from DPS, UIU, and New York City. My preference generally is to have DPS go last, unless you have some other concern.
Yes, Your Honor, I had sent...
Oh, I'm sorry, yes, there's 5 minutes for Assemblywoman Pauling as well. So let's start with UIU. I'm just going to follow the order on the chart other than making staff go last all the time.
Okay, good morning, I'm Saul Rickberg. Good morning, panel. I don't know if you can hear me. So I can't really hear anything because of this sound. So I can't hear what's happening. I'm sort of in a bubble. But I will go. I'm focusing on your rebuttal testimony. I need these guys here. Thank you. If you turn to page 31 of your rebuttal testimony, please. Do you have that? At line 1, the state, Mr. Majoris also tosses around red herrings, such as references to the Supreme Court of the United States and notions of creating regulatory liabilities for net salvage based on SEC, non-commissioned financial reporting rules, which we also address in this rebuttal testimony. Do you see that? Which Supreme Court cases are you referring to when you use the word red herring?
That would be the one in Mr. Majoris' testimony.
And is that the Lindheimer versus Illinois cell case?
Correct.
And does that case address excessive depreciation?
It does.
Is it impossible for depreciation expense to be excessive?
It's certainly not impossible for it to be excessive. It has to be proven that it is excessive, though.
Does the phrase gross salvage generally refer to value received from retired assets?
Yes.
Does the phrase cost of removal generally refer to the cost incurred to dispose of retired assets?
Yes.
Does the phrase net salvage generally refer to the difference between gross salvage and cost of removal?
That's correct.
Does the phrase negative net salvage generally refer to a situation where cost of removal exceeds gross salvage?
Correct.
Do you include negative, or does the company include negative net salvage ratios and depreciation rates to collect for negative net salvage?
Yes, that's the standard procedure throughout the country.
Do negative net salvage ratios increase depreciation rates to recover negative net salvage?
Yes, the idea is to, because it's negative, there'll be a cost incurred at the end where removal cost will exceed salvage, so that amount must be recovered over the life of the asset.
Has the company historically included negative net salvage ratios in its commission-approved depreciation rates?
To the extent that they've been approved in the case, yes.
And did the company include negative net salvage ratios in its proposed depreciation rates in this file?
Yes.
Does the company record the resulting depreciation expense in the accumulated provision for depreciation, amortization, and depletion?
I didn't quite get the question. Could you repeat?
Does the company record the resulting depreciation expense in the accumulated provision for depreciation, amortization, and depletion?
Yes, the depreciation expense is a credit to the reserve for depreciation.
Thank you. If you could please turn to page 99 of the rebuttal testimony, starting at line 15. Does the question posed there assume that Mr. Majoros is recommending that the commission should establish the company's asset retirement obligation, or ARO, as a regulatory liability?
Well, I'd agree that the question states that, yes.
Okay, I want to show you a document.
Are we marking this?
Yes, this is a document consisting of 3 pages from Part 101 of FERC's Uniform System of Accounts. Yeah. I only brought 20 copies, so maybe each party could just have 1 or 2. Well, I would ask that this be marked for identification. I guess 758 would be the next number.
It'll be marked 758 for identification.
Your Honor, I would like the record to note that these are not continuous pages in the uniform system of accounts.
Yes, it's correct. We have the first page to show the title of the document. And our question refers to page 378, the third page of the document. On the left-hand side, the paragraph mark is number 25. My question refers to the first sentence of paragraph 25A, which I won't read since it's, maybe I'll put it in the record. Does the first sentence state, an asset retirement obligation represents a liability for the legal obligation associated with the retirement of a tangible, long-lived asset that a company is required to settle as a result of an existing or enacted law, statute, ordinance, or written or oral contract, or the legal construction of the contract under the doctrine of promissory estoppel. Do you see that?
I see that, yes, it says that.
Now, in that sentence, is it correct that the uniform system of accounts are describing legal asset retirement obligations?
That question is really beyond the scope of our testimony. We're going to defer that to our accounting panel.
Okay, you yourself don't know what that sentence means?
It's beyond the scope of my understanding.
Okay, turning to page 100 of your testimony. Line 2. You see where you say Mr. Majoros incorrectly refers to the non-legal ARO reserve as a liability the company owes to ratepayers?
We see that.
Okay, now, with that in mind, and also the sentence that you weren't sure what it means, how would you define a legal asset retirement obligation?
Objection, Your Honor, calls for legal conclusion.
Could you perhaps restate the question, Mr. Richards?
Yes, Your Honor. The witnesses states that Mr. Majoros incorrectly refers to the non-legal ARR reserve as a liability the company owes to ratepayers. And therefore that suggests there's some understanding of the uniform system of accounts and legal and accounting issues. So I'm just asking what the panel's understanding is what is a legal asset retirement obligation. It says Mr. Majoros didn't understand what a non-legal obligation is. So I think they should be able to answer that question.
It sounds to me like it's more of a accounting type question. I shouldn't use that word because now you're going to say pass it to the accounting panel. But I'm not sure. I'm not convinced that it requires a legal conclusion. Are these words legal and non-legal ARO reserve? Are they terms of art? Speak into the microphone. Whoever's going to answer.
The definition of an asset retirement obligation. Can you hear me?
Barely.
Does the light come on?
Yes. The light should be on if it's on.
Judge, if other people turn theirs off, it might help.
Anybody who's not speaking in the room should have their mic off.
definition of an asset retirement obligation represents where the company has a legal obligation to remove an asset at the end of its life, such as a nuclear power plant. That would be an example of a legal obligation, which is a definition of an asset retirement obligation. We're referring to non-legal asset retirement obligations. The company has many of these assets, such as the removal of poles, overhead lines, which would fall into the definition of a non-legal asset retirement obligation. The company incurs costs at the end of the asset's useful life that needs to be collected from customers. And our suggestion and the industry practice is to recover those costs over the useful life of the asset, so that customers that benefit from its use also pay the full cost of the service value of that asset.
Could you explain again what is a non-legal ARO? Reserve?
Did I understand you to mean that it's an obligation that, it's something where you don't have an outside obligation to a third party, but you have to do it anyway?
That's correct.
Thank you. In that term, non-legal ARR reserve, what is the reserve?
The dollars of a non-legal obligation are recorded against the accumulated provision for depreciation as a debit.
So we don't really hear what he's saying, so it's really hard for us.
Brandon, could you give him your mic and see if that one works better?
It's not going to reach. Go this one instead. Just switch your lens off. Yeah, let's try it at the table. Let's try it at the table.
Maybe we could repeat the question.
Your Honor, I think from previous hearings, a couple of us remember they used to be able to do something in the back to boost the volume.
Except that they couldn't hear.
All right, let's try to muddle through while somebody tries to figure out the difference in sound. All right, we were all lost now. What's the pending question?
Oh, sorry, yes, thank you, Your Honor. The pending question, what is a reserve? In the term non-legal AR reserve, what is a reserve component?
My previous answer was that the dollars represent a debit to the accumulated provision for depreciation. That account, the accumulated provision for depreciation, is normally or can also be referred to as the reserve for depreciation. I think that's the answer to the question you're asking.
Thank you.
Is that the same thing as money set aside to pay for whatever that item was?
Yes, Your Honor, we recover removal costs to pay for the ultimate retirement of an asset at the end of its life.
Okay, going back to the exhibit I handed you in paragraph 25, Is the uniform system of accounts describing legal asset retirement obligations?
This is where we've got to draw the line and defer to the accounting firm.
But did you consult with the accounting panel when you prepared the sentence on page 100 saying that Mr. Majoros incorrectly refers to the non-legal ARO reserve as a liability the company owes to ratepayers?
We did.
Okay, and does the accounting panel discuss this topic?
They did not discuss it in their testimony. They've agreed to discuss it in the hearings if required.
But how would a party know that the accounting panel should be asked questions about this part of your depreciation testimony?
Because I'm letting you know that now. We're aware that the accounting panel is coming after us in the case.
Are they coming today, Your Honor? Our expert is here today to help with cross, and we didn't realize that this topic is the subject of another panel.
They're not scheduled for today.
Okay, Your Honor, we would like to reserve some time to cross that panel whenever they're up.
Okay.
And I assume they will not reference your panel and say we should have asked you.
Objection, Your Honor.
Okay, let's proceed. Come on.
Okay, again, looking at page 100 of your testimony, does the non-legal ARO reserve exist because the company has collected money from ratepayers for non-legal removal costs?
You're going to have to clarify for me what reserve you're talking about. If it's the reserve that I answered about, the accumulated provision for depreciation, that reserve has been there since the beginnings of the company.
I'm referring to the non-legal AR reserve that you mentioned in your testimony.
I don't understand the question.
Is the non-legal ARO reserve the excess of the company's collections for non-legal removal costs over the amounts that is actually recorded as cost of removal?
It doesn't represent an excess. It represents accruals for depreciation that are related. It represents accruals for net salvage that are in the depreciation reserve, but it doesn't represent an excess. Those monies will be spent in the future.
I'm not sure if we heard your answer, or if you heard our question. The question is, you were talking about excess, but our question's focusing on what's reported. So the question is the non-legal ARO reserve the excess of the company's collections for non-legal removal costs over the amounts that is actually recorded as cost of removal?
Could you rephrase that? I'm not sure I understand what you mean when you say excess.
Can you ask the question without using the word excess? rephrase it in a way that doesn't use that word, because it's apparently a term of art.
Try another word. Is the non-legal ARO reserve the overage of the company's collections for non-legal removal costs over the amounts it is actually recorded as cost of removal?
I'm still not sure I completely understand that. The accumulated provision for depreciation includes depreciation of vehicles which have a component of the original cost of the asset and of net salvage. It includes
Excuse me,
retirement.
could you speak right into the microphone instead of looking at anybody?
It includes, did you hear everything? Should I start?
No, I haven't heard what you said.
The accumulated provision for depreciation includes depreciation accruals, historic depreciation accruals, which include a component of both the original cost of assets and of net salvage. And then there's also retirements, reported net salvage, and some other transactions that are reported there. I'm not sure I completely understand what you're getting at with the question, but there is a component for cost of removal that will be incurred in the future.
Does the GAAP and the SEC require the company to report that amount as a regulatory liability to ratepayers?
We're going to defer that to the accounting firm.
Okay, I have another document I'd like to hand the panel.
Mr. Rigler, could you describe the document for the record?
Yes, Your Honor. This is a document consisting of 7 pages from the company's December 31, 2012 FERC Form 1. And I would ask that be marked for identification of the next available exhibit.
It'll be marked Exhibit 759 for identification.
Your Honor, if there's a moment, there's some extra plugs here, and it looks like extra mics. I'll happily hook one up.
If you could sort of do that while we're working.
Do you have that document before you?
Yes.
Thank you. You turn to page 110, that's the second page of the document. And if you look at line 5, it says it's the accumulated provision for depreciation, amortization, completion. See that line?
Yes.
Is the December 31, 2012 balance in that account $6,000,000,000 $505,568,671. So the current year and the quarter year.
Yes?
Turn to the next page of the document, page 3 of the document. And the title towards the
Excuse
top.
me, Your Honors, has there been any foundation that these witnesses are familiar with this document in any way?
I haven't seen anything that concerns me yet based on what he's asked. This is a report filed by Con Edison, so they should be familiar with it.
With all due respect, perhaps not these particular people.
Well, they're perfectly capable of saying that, since that's said several times already. Go ahead, Mr. Richard.
Thank you. On the third page, which has a heading of notes to financial statements continued, under do you know if these notes apply to the comparative balance sheet and other financial statements included in the company's December 31, 2012 Form 1?
Do I know if they apply to that?
Would you agree that they do?
I would agree with you.
Thank you. Now, if you could look at the second paragraph under note Q. That paragraph, that's the first sentence says the company includes in depreciation expense the estimated removal cost less salvage for company plant assets. You see that sentence?
Yes?
And the next sentence, in accordance with the accounting rules for asset retirement obligations, future removal costs that do not represent legal asset retirement obligations are recorded as regulatory liabilities pursuant to the accounting rules for regulated operations. Do you see that?
Yes?
And does that mean that the company's collections for non-legal removal costs are recorded as regulatory liabilities?
It means that for SEC purposes, yes.
Thank you. And the next sentence says the related regulatory liabilities reported to Con Edison in New York for $420 million at December 31, 2012, and $372 million at December 31, 2011, respectively. You see that sentence?
Yes?
Okay. Now, if you look at the next few pages of the document, page 271, 278, 278.1, 278.2, and 278.3. Would you agree that the $420 million regulatory liability for non-legal asset retirement obligations is not shown on these pages?
I don't see it, and I would accept that it's not shown on the list.
Okay, thank you. Is it correct that the company's $420 million liability for non-legal asset retirement obligations is included in the company's $6.5 billion accumulated provision for depreciation, amortization, and depletion in Form 1 that we discussed earlier?
We have to know whether you're referring to PSC books or SEC books. For rate-making purposes, the number you're referring to is included in the reserve for depreciation.
Is it also true that the paragraph we read on Form 1 that we talked about earlier is actually referring to financial reports for the SEC and for shareholders?
I'd have to
Objection,
refer
Your
that
Honor.
to...
What's reported to SEC and shareholders appears to be beyond the scope of this proceeding.
I also wasn't sure which document you were referring to, Mr. Richter.
That was part of the Form 1 we just discussed earlier.
Is that Exhibit 759, is that Form 1?
Yeah, 759, the one we're talking about.
Maybe you could rephrase your question and show me where on Form 1 you're talking about when you, as part of the question.
Okay, if you turn back to the second page of Exhibit 759, page 110 is line 5.
That's where you identified a
And then the
$6.5 billion number?
Right, and then on the next page, the paragraph, the second paragraph under no Q mentions the $420 million.
Okay, with those two things right in front of me now, ask me a question.
Okay. Is it correct that the paragraph on Form 1, page 123.55, that's the second page, is actually referring to the company's financial reports provided to the SEC and to shareholders?
I don't personally know which set of books it's referring to there. I defer that to the accounting firm.
Let me ask a question. Is the $420 million on page 123.55 included in the $6.5 billion figure on page 110?
It is, Your Honor.
We're handing the panel and the ALJs a document that is a calculation that we prepared. We'd like you to look at that. It's a one-page document entitled Con Edison Company of New York, Inc., Comparison of Accumulated Provision for Depreciation and Amortization.
This will be marked as 760 for identification.
Would you agree that the Form 1 basis reserve is about $6.5 billion, and that the SEC GAAP basis reserve is about $6.1 billion?
I'd agree with that. Yes.
So would you also agree that this exhibit shows that the Form 1 basis reserve is about $420 million more than the SEC GAAP basis reserve?
I would agree, but I don't see how that has anything to do with setting rates in this proceeding.
One more document, Your Honor. Your Honors. This
Can
is,
you, just one moment, the last document, marked 768, that's something you prepared?
yes, Your Honor. This next document is the company's response to the UIU's question 292.
Why does it say page 1 of 2 at the bottom and there's only one page?
That's the way the document came to us, Your Honor.
Okay. All right, we'll mark this as 761 for identification.
I think page 2 is just blank. And do you see the response that's, or the response states, in general, the company does not fund any liabilities except for retiree benefits as required by law?
I see that, but I'd like to point out that this interrogatory was responded to by our accounting panel. It's probably better that the questions be directed to them.
You don't know if this answer is correct?
I'd rather defer the question to the accounting panel who answered it.
We, our IRs were directed towards your panel, so
Objection, Your Honor. There's no rule that the person submitting the interrogatory can direct the company as to which witness must respond.
I agree to that. Let me ask, the company's non-legal AROs, are they funded or are they not funded?
Your Honor, I'd rather defer to the accounting panel.
Do you know the answer?
I believe I know it.
Tell me what you believe the answer is.
I believe that the company does not fund their legal obligations.
Okay. If we want to know for sure, we got to ask the accounting panel.
I think so, Your Honor.
no further questions, Your Honor.
Thank you.
Thank you for asking that last one.
Okay, the next questionnaire, I believe, is New York City.
Your Honor, can I just note, I think I understood earlier that Mr. Glass indicated that by a note to you, he had reserved a limited amount of cost for this panel?
5 minutes.
Okay, I would like to just check with a couple of my colleagues. To our knowledge, we didn't receive any notice.
I know he didn't send his note to anybody except me.
Okay, I guess we'll not object to that cost for this witness. We would like to know whether or not Mr. Glass has sought to reserve costs for any other panel.
Yes, he did, and I'll give it to you now. I meant to get to this, but I put it aside. He's got 5 minutes for the steam fuel panel on Wednesday, which is a Con Edison witness. He's got 5 minutes for the steam infrastructure and operations panel, Con Ed witness on Thursday. And he's got 5 minutes for the electric infrastructure and operations panel on Monday. 5 minutes for Musillo on Tuesday of the 30th. 5 minutes for Mr. Arnett, who is a New York City witness on the 31st. and that's it. All of those panels were already being called, and they were only 5 minutes per request, so
Understood.
it doesn't
Your
affect
Honor.
the overall schedule. But yes, he should have notified everybody, not just me.
I'm sorry, Your Honor, I thought you were going to be issuing, since you had sent out a letter to everybody, I thought you were going to be issuing a new schedule and tell
The
it.
time, I would have liked to, but time did not permit.
Yeah, was my assumption, I'm sorry.
Can I just assume, Your Honor, you haven't received any other requests by any other parties?
The only other one I have penciled in came in from the Consumer Power Advocates, which was circulated. I just hadn't picked it up on my schedule.
Understood, Your
And
Honor.
they sent a note to everybody.
We received that notice from
Yes,
Mr. Dell.
that's the only other one I have. Okay, New York City.
Okay, good morning. My name is Adam Conway on behalf of New York City. I have a few questions that will focus on depreciation, and in particular, the panel's rebuttal testimony. And if you could please turn to page 32 of the rebuttal testimony, specifically on line 6. And you state there, we will also demonstrate that over time, the traditional accrual method actually results in lower costs to customers compared to the other parties' proposals. Is that correct?
Yes.
And this demonstration here, you present this demonstration in figures 5 and 6, which are on pages 94 and 95. And in tables 11 and 12. Is that correct?
Yes, that's correct.
Okay, thank you. And just sticking with these two figures and these two tables, figures 5 and 6, and tables 11 and 12, is it correct that the panel assumed that actual net salvage will be equal to the Con Edison accrual under the current method?
Could you rephrase that question, please?
Sure. So maybe if we just go to page 68 and look at table 8. Do you have that?
Yeah.
And so what I was asking is basically for your analysis in these figures and tables, the panel assumed that actual net salvage would be equal to the proposed net salvages listed in column 2 of this table 8. Is that correct? you go back one page on your rebuttal testimony to page 67, there's a section here that starts, Con Edison's net salvage estimates are conservative. Correct. And the table 8, that table 8 is within this section stating Con Edison's net salvage estimates are conservative. Correct.
Yes.
And then you note here on page 67, beginning on line 9, that the city's witness, Mr. Arnett, agrees with your claim that the Con Edison negative net salvages are conservative. Is that correct?
Yes.
And just turning back again to table 8 on page 68, you would agree that for several of the accounts listed in this table, the percentages listed in column 2 are substantially below the 5-year average shown in column 4, as well as the lifetime historic averages shown in column 3. Is that correct?
Yes, that's correct.
I'd like to refer to 2 documents here. They're the panel's responses to 2 of the 2 city discovery requests, 663 and 665.
If I got extras, I'll get it back to you. Yeah, 2 right. I'm gonna mark this 2 separate.
2 separate, yes.
Okay, I've got 2 proposed exhibits here. First one is 3 pages, and it is a response to question number 0663. That'll be marked 762 for identification. And I've got a 3-page document, which is a response to question number 0665, and that'll be marked 763 for identification.
Yep. Sorry. You guys need another one?
I couldn't hear you.
Exhibit 762 is the answer to 0663, and Exhibit 763 is the answer to question 0665.
Which one do you need? Anybody else need one?
Okay, I just want to start with 663 here, specifically the response to 663D. The panel was asked to please provide revised figures 2 and 4 and table 11, assuming that actual negative net salvages were equal to the most recent 5-year averages shown in column 4 of table 8. And then in the response, the panel declined to perform that study. Is that correct?
Yes, that is correct.
And then in the response to 665, the panel was asked to provide revised figures 5 and 6 in table 12, assuming that actual negative net salvages are equal to the most recent 5-year averages shown in column 4 of table 8. And the panel also declined to provide that study. Is that correct?
What part of the interrogatory are you referring to?
That's 665A.
It's on page 2. The second response.
Yes, the company declined to provide that data because all of the necessary information to do the calculation yourself had already been provided in the workbook.
Okay, thank you. Would you agree that the outcome of these figures and tables, figures 2, 4, 5, and 6, and tables 11 and 12, would be different if the assumption on actual negative salvages had been less conservative?
We agree that you would have different results, but without actually performing calculations, there would still be a crossover point where the alternative method becomes more costly in the future.
But just going back to the question, you agree that the outcomes here would have been different had the assumption?
Can you explain better what you mean by outcomes? I think that's the word we're kind of talking about.
Sure. So just to give you an example, if we turn to go to any of them. You can go to figure 5 on page 94. And you stated before that the analysis in here assumes that actual net salvage is equal to the Con Edison accrual under the current method. And I'm asking you that the outcome of this chart, as presented in figure 5, would be different if the assumptions on actual negative net salvages were less conservative.
I think the word you're using, accrual, isn't exactly right. We use the net salvage estimate from the study to project future net salvage costs. The accruals in each case are based on the various proposals by each party.
Right, okay, so, I mean, just maybe I can clarify here on figure 5. Like maybe you said this earlier, but the crossover point, if there is a crossover point, would be different on figure 5 had you used a less conservative negative net salvages when preparing this figure.
Are the less conservative figures you refer to, is that in the depreciation accruals or the cost that will be incurred in the future?
In the actual costs incurred.
So if the costs are different, the numbers in the graph will be different, but I would expect that there would still be a crossover.
But you haven't performed any analysis on that?
I have done that.
Okay, if we could turn to just figure 4 on page 88, and also table 11 on pages 91 and 92. The analysis presented in this figure in this table covers only plant in service as of 2011. Is that correct?
Yes.
Is it the panel's position that the commission should base its decision on an analysis that does not recognize how plant balances might change over time?
This figure was put in our testimony to explain that although accruals right now are greater than the cost, over time that changes and you recover the full cost of net salvage for all plants. So it's an illustrative example to demonstrate that point, that the methodology that's been in place for a long time and accepted by almost all jurisdictions, including this one, does in fact recover the full cost over the life of the asset.
So if you turn to figure 5, which is on page 94, and looking at table 12 on page 96 as well, unlike the illustration in figure 4 in table 11, the analysis that you present in figure 5 and table 12 uses a 3% assumption on the rate of growth of plant. Is that correct?
Yes, that is correct.
If I could just turn back to the response to City IR 665, which was marked as Exhibit 763. In question, or part C of this question, the panel was asked, besides depreciation expense and return on rate base, please list all other components of the revenue requirement that will change under the alternatives presented by staff, UIU, and the city. In response, the panel stated the components of the revenue requirement that would change over the approximately 40-year period presented in figures 5 and 6 under the alternatives presented by staff, UIU, and the city cannot be stated with certainty. Generally speaking, reflecting higher costs in the revenue requirement increases the revenue requirement. Increased revenue would generally result in increased costs such as gross receipt taxes, state and federal income taxes, New York City corporate franchise tax, public service law, Section 18A assessments, regulatory commission expense, and uncollectible accounts expense. In addition, the higher carrying cost on rate base due to lesser or delayed recovery of net salvage costs could trigger higher financing costs that would increase the revenue requirement. My question here is many, but maybe not necessarily all of these items that were just listed in this response are directly proportional to depreciation accruals plus rate base costs. Is that correct?
We can't speak individually to the effect of each of those. That could be asked to other witnesses responsible for those expenses. However, we can say that we've seen other analyses similar to ours that have included other components of rate base that have come to more or less the same conclusions as us, that there is that crossover point. I would also note that in Commission Order 08-E-0539, the Commission also noted that there would be a crossover point. This is on page 52 of our rebuttal testimony in item number 2.
So let me just give you an example here. So one of these items that you list is the 18A assessment in this response to 665C. And I guess my question here is, assume that revenues rise by 1%. Then the 18A assessment rises in direct proportion to that. Is that correct?
I think it's beyond the scope of our testimony. We're depreciation experts, not revenue requirement experts.
Would you accept that subject to check, that if the 18A assessment, if revenues rise by 1%, then the 18A assessment will rise by 1%?
I don't know if the 18A assessment rises at the same pace as revenue.
Okay. Well, let me ask you, isn't it correct that in any year that the company's depreciation accrual for net salvage is greater than the company's actual net salvage incurred, an income tax liability will be created?
Again, I don't know the answer to that. I'm not a tax expert.
So, it's true that, isn't it, that the panel's comparisons here of the various depreciation proposals that have been presented in these proceedings don't incorporate an income tax liability?
That's correct.
Just one more question here. All of the analyses that we just discussed in the figures in the tables, figures 4, 5, 6, tables 11 and 12, they're all based on nominal dollars, is that correct?
Yes, that's correct.
Okay, I don't have any further questions.
Okay, Assemblywoman Ballin?
Thank you. I just have a few questions. Are there any property tax consequences of the proposed transfer of the Hudson steam plant from the steam system to the electric system?
Could you define consequences?
Are there will property taxes that were previously paid by the steam system now have to be paid by the electric system?
That would be the consequence, yes.
Okay, and do you know how much those taxes would be?
I normally would. I don't have that number with me.
Could we leave a space in the transcript for them to provide that information?
Sure.
And then just be clear, specifically what student?
For the Hudson Avenue plant that's being transferred from steam to electric.
What are the current taxes?
What will be the property taxes? You also indicate on page 32 of your testimony that there's going to be, that you're proposing an amortization of $92.3 million of undepreciated costs related to the Hudson Avenue station over 20 years. Do you recall that?
I do.
And you project that at, over 20 years, to be roughly $4.6 million a year. Is that correct?
Yes, it's the unrecovered cost divided by 20. There's no projection there.
Is there any interest or any other costs that would be incurred?
I don't know the answer to that.
Then how can you say that the yearly cost would be $4.6 million if, all you did was a simple division. So if there's any carrying costs, you have not included that in your testimony. Is that correct?
We were speaking only of the unrecovered cost amortization. The accounting panel, again, would include any of the other type costs that might be associated.
Your Honor, so I would request that I be granted 2-3 minutes just to speak to the accounting panel on that issue. Are there any other costs that would be incurred by the electric system due to the transfer from Hudson Avenue from the steam system to the electric system?
Again, our panel is only testifying to the depreciation costs. That's about it. Depreciation and property taxes.
And depreciation doesn't take into account any other costs, you just assume it's you take the current amount, you depreciate it straight, no interest, nothing else.
That's correct.
Thank you, that's all here.
Thank you. DPS.
Thank you, Your Honor. This is Frank Village. Turning to page 69 of your rebuttal testimony. On that page, you state that in 2011, plant balance for account 364, which is poles, towers, and fixtures, was $395,429,151. Do you agree that this information is contained in Con Edison's annual report for 2011? Provided to the Commission.
I object, Your Honor. The question is vague. What report?
The Con Edison annual report provided to the Commission.
I would like, are you asking me to confirm the number that's in the report?
The number comes from your testimony on page 69.
I saw the number in testimony, yes. I don't understand what you're asking.
I'm asking if you agree that number is or should be reported on Con Edison's annual report to the Commission for 2011.
I have to see the document. I'm aware that there's a section in the PSC report that reports the average plant balance. I'm not sure if that's what you're getting at.
Okay, I want to ask a couple questions about this account 364 from 2001. And the plant balance for 2001, as reported in Con Edison's annual report for that year to the Commission, was $239,965,000. And this is on page 337A of the annual report, which I do have copies of that, if that would be helpful to you.
That would be helpful.
Could you tell us what this document is, please?
This is page 337A, as stated down on the bottom of it, from the Con Edison annual report provided to the Commission on April 30th, 2002, for the year ending December 31st, 2001, as it states across the top.
Okay, we'll mark that one page as exhibit number 764 for identification.
Excuse me, Your Honor, but we would all like copies, and your ruling said that we're supposed to provide enough copies to the board.
We would like copies going on.
Sorry, I thought I gave you all copies. If you look on line 15.
Hold on one second. Okay, everybody got a copy now? Good, all right, go ahead.
If you look on line 15 of this document, that shows account number 364. Does it state in column B that the depreciable plant base or the account balance is $239,965,000?
I would agree, it says that number, however, I don't believe that that's the December 31st, 2002 position.
2001 position.
2001 position, so.
Could you explain why you don't believe that?
I think if you would have looked on a later page, there's a note covering that column that says it's the average depreciable plant balance computed by taking the 12 monthly plant balances and averaging them out.
So then this represents the average plant balance for that account for the year 2001.
That's correct.
And similarly in column C, does it show that the average service life for that account is 40 years?
It does.
And the net salvage, which is in column D, is negative 75%?
That's correct.
And now on page 93 of your rebuttal testimony, you discuss account 369.2, which is underground services.
Can you repeat that page number?
93. And going back to exhibit 764, which shows the amounts for during the year 2001, line 22 shows account number 369, and that's 369.2, so there's a 369 right above it as well. And is the account balance, the average account balance for the year 2001, $595,134,000 for that account?
It is, again, the note would tell us if we're dealing with overhead or the underground portion of the account, but I believe that that's the underground portion, which is the same one referred to in the testimony.
And the estimated average service life for that account in 2001 was 65 years?
Yes.
And the net salvage percent for that account in 2001 was negative 115%?
That's correct.
And now, throughout your testimony, you referred to the neighboring public utility depreciation practices published in 1996. Do you consider yourselves familiar with the contents of that publication?
Yes, I think we would consider that true.
So I have a 3-page document which has the title page of that publication and 2 pages from that publication. Page 122 and 123. And if that can be marked as an exhibit for the next available number.
Okay, we got a 3-page document. The cover says Public Utility Depreciation Practices, August 1996, and it's marked Exhibit 765 for identification. Okay, everybody got it? Let's proceed.
So now, turning to pages 117 through 121 of your rebuttal testimony, on those pages you have a series of figures showing a comparison of the observed life tables and various survivor curves for account 364, which is poles, towers, and fixtures. And the figure on page 117 shows the entire observed life table, while the figures on pages 119 through 121 have a truncated observed life table, such that you remove the observed life data after age 57. Page 122 of the NARUC manual refers to this action as a T-cut, correct?
That's correct.
Now, the next two paragraphs from the NARUC manual, from the excerpt from the NARUC manual, describe a couple of problems that can arise when using T-cuts, correct?
Well, it certainly has some language that says you should be careful when performing a T-cut. Sure.
And then the manual states in the fifth paragraph under the T-cuts heading that both of the problems mentioned above are exacerbated when the T-cut occurs near the mode of the retirement frequency curve, i.e. the steepest portion of the survivor curve. Therefore, T-cuts near or at the mode of the retirement frequency curve should be avoided. Is that correct?
I see that.
And turning now to property taxes, if we can turn to page 13 of your rebuttal testimony. And this specifically refers to the question and answer in lines 7 through 17. So in this paragraph of your testimony, you discuss tentative tax rates for New York City that could be in effect for the 2013 and 2014 fiscal year, and the impact those rates would have on property tax amounts for the rate year. Do you know what the actual rates for 2013 and 2014 fiscal year will be now?
I do not know them for certainty, no.
And when do you expect to know?
I would expect that in November we'll know the final rates.
Is that when the property tax bills are issued?
No, the property tax bills will be issued after that date, perhaps a month later. The city just takes some time to produce them after arriving at the final rates.
And in your experience, how closely do you expect the actual taxes for fiscal year 2013 and 2014 to compare to these tentative figures that you brought out in testimony?
I can only calculate what I know, and what I know is what I received as tentative rates. I can't say how close they're going to be. In my communication with the city, first of all, I was told that they're confidential, number one. We haven't shared those rates. And number two, I was told that it's a near certainty that they will change, but to the extent that they'll change, I don't know.
Is this something that's going on in past years with the city where you get tentative rates?
I try to get tentative rates, yes, every year.
And I guess in your experience, do these tentative rates tend to be reflected in the actual rates, or is there a fair amount of variability?
I really can't say. I believe they've been accurate at times, and they have not been accurate at times.
Fair enough. No further questions, Your Honor.
Thank you. Any redirect?
No redirect.
Thank you. The panel is excused. I believe the next witness is being sponsored by UIU.
Want me to go back on record?
Yeah. Okay, Mr. Rigber, who are you calling?
Your Honor, this is Lieutenant Michael Majoros for cross-examination. Mr. Majoros, do you have any...
Raise your right hand, please. Thank you. Do you swear or affirm that the testimony you are about to give will be the truth, the whole truth, and nothing but the truth?
I do.
And do you adopt your pre-filed testimony as your sworn testimony in these proceedings?
I do.
Okay, Mr. Rigber.
Mr. Majoros, do you have any substantive corrections to your direct or rebuttal testimony?
Yes, I have one substantive correction, and it impacts several several testimony pages. It's going to be the same change on each of those pages. It starts with my exhibit MJM 8, my direct testimony. It's the last exhibit. And this is the Form 10K page from which I drew the $503 million regulatory liability for cost of non-legal AROs. And I cite the $503 million throughout my testimony. That is Con Ed Holding Company. Con Ed of New York is $420 million, as was discussed this morning. So I can go through each page and make that change. They are pages 22, 24, 27, and 28 of my direct, and pages 4, 6, 9, 10, and 11 of my rebuttal testimony.
Your Honor, we'll submit a corrected version after the hearing, making that one change on those 9 pages.
That won't be necessary because it's already been read into the record.
Okay, thank you.
Thank you. Okay, is the witness available for cross?
Yeah, that's correct, Your Honor.
Okay, Con Edison. I've got you down for 15 minutes.
May we go last with this? Or is that what was going to be in?
The only other cross is from New York City. Do you mind going first, New York City?
I thought we had sent a note in waiving our cross, Mr. Majoros. We don't have any questions of him.
I don't have that on my master sheet.
I apologize, Your Honor. I thought we did.
Okay. All right, then it's just Con Edison. Do you need a minute?
Ready?
Go ahead, please.
Mr. Majoros, he's been handed a document that indicates it's...
Please use the microphone.
Mr. Majoros, you've been handed a document that indicates it's your response to an interrogatory of PSC staff, interrogatory number EPS 700. Do you accept it as your response?
Yes.
Shall we mark this as an exhibit?
Yes, sir, please.
Okay, it's a 2-page document. It's response to DPS 700, and we'll mark it 766 for identification.
Mr. Majoros, in this response, you perform a theoretical reserve calculation for a particular plant account 367, correct?
Yes.
And in the response, you explain how the calculation works and explain the input data, correct?
Yes.
And this question asks you to confirm whether or not your proposed theoretical reserve reflects your proposed salvage rates, correct?
Yes, sir.
And you selected this particular account just by way of example. The methodology you used here, you used across all accounts, is that correct?
Yes.
Your Honor, may we have the single-page document then in caption theoretical reserve formula marked as next to zero?
Could you just give it a little identification?
There's a caption, theoretical reserve formula at the top.
But it's a calculation prepared by Con Edison? Or by the
In
witness?
part.
Okay. Exhibit 767 for identification.
Mr. George, do you have that document?
Yes.
Okay. And on the very first line in section A, would you agree that...
Please speak up.
The very first line in section A of that document that begins with theoretical reserve percent, would you agree that the equation in the middle of that line is simply a replication of the equation in your response to DPS 700 that appears just below where it says account 367? The 5 lines from the bottom.
Yes.
And that's your calculation of the theoretical reserve percent for this particular account. And then the next line where it says theoretical reserve, that's the theoretical reserve you calculated for this account by multiplying the theoretical reserve ratio calculated on the first line times the plant investment, correct?
Yes.
And the 579, 472, 283 theoretical reserve is the same answer as you have in your response to TPS 700, correct?
Yes.
Looking down to section B. Do you agree that on the first line in section B, the equation that appears is the same as the first line in section A, except for the salvage factor?
It appears to be, yes.
Looking at the next few lines in section B, I'm not going to ask you to do the arithmetic now, but if you want to, that would be fine. Does that appear to you to be the mathematical steps leading to the 12.46 at the bottom?
I'm not sure. I'd have to have a calculator. I'm not challenging you.
I understand. Well, so
let me here. I'll give you a better answer if you give me just some time to
fine with me.
They look like the right steps,
Thank you.
and it appears to demonstrate something here.
Okay. So
I guess you got
that, the theoretical reserve percent of 12.46, that's calculated there, when multiplied times the plant balance for account 367 that you use in your interrogatory, results in, you can accept this subject to check, that multiplication results in the same.
No, I'm not accepting subject to check.
Okay, you don't have to, sir. The arithmetic will speak for itself. You get the same 579,472,283 theoretical reserve as you calculated, correct?
Yes, that's the answer on that page.
Nothing further, Your Honor.
Any redirect? Do you want to consult?
No, Your Honor.
Okay, thank you. Witness is excused. Okay, if DPS could call the next witness.
DPS calls the staff depreciation panel.
And if Con Ed's next panel could get its name cards ready.
They're on.
Raise your right hand, please. Do you swear or affirm that the testimony you are about to give is the truth, the whole truth, and nothing but the truth? And do you adopt your pre-filed testimony as your sworn testimony in these proceedings?
My understanding is the panel does not have any substantive corrections to make to that testimony. That's correct. Your Honors, the panel is available for cross-examination.
Okay, the only people I have on here is Con Edison. Please proceed.
In your testimony, you address variations between theoretical reserves and the reserve for depreciation for the company's books, correct? General subject.
Between book and theoretical, yes.
In your review and in your studies in this case, in your opinion, is it a fair statement to say that the net salvage for most of the company's plan accounts is a negative net salvage?
The vast majority, I think there might be one that's positive.
Excuse me, there might be one that is
Might
not.
be one that's positive, but I think for the most, there's mostly all negative.
Could both the questioner and the answerer speak into the microphone a little better?
The theoretical reserve that does not reflect negative net salvage would be understated, correct?
I'm sorry.
A theoretical reserve that does not reflect negative net salvage, when it should, would be understated, right?
That's correct.
And if the theoretical reserve is understated, that would make a book reserve seem higher by comparison, correct?
By the math, yeah, that's what would happen.
So by that, a a book reserve deficiency would appear to be less of a deficiency, and a book reserve excess more of an excess. Is that true? I'm taking one at a time.
If you're not, this is assuming you're not reflecting salvage.
Assuming the theoretical reserve does not reflect
Negative.
negative net salvage
Negative net
when it
salvage.
should.
Yeah, then you're going to have discrepancies above and below.
So just by way of illustration, if the correct theoretical reserve, including negative net salvage, is 100, and the book reserve is 90, there's a book reserve deficiency of 10, right? If the correctly calculated theoretical reserve equals 100, and the book reserve is 90, there's a book reserve deficiency of 10.
No, there's excess of 10. The theoretical is more than the book, excess.
So the book
No, I'm
is
sorry.
deficient.
No, I'm thinking back.
Okay.
I'm sorry.
Okay.
You're right. You're right. I'm sorry.
And if the theoretical reserve that's correctly calculated to be 100, but calculates to only 90 because negative net salvage that should be reflected was not, then that same book reserve of 100 would appear to be excessive, right?
That's correct.
Do any of the depreciation factors, lives, tables, net salvage factors that you propose to be adopted in this case produce a negative theoretical reserve balance for any account?
I don't recall that. That's for all gas, electric, and steam.
All accounts that you look at. Let me put it this way. Would that result make sense? A negative theoretical reserve?
No.
Okay.
I was thinking the other way, that you do have a couple of electric production costs that have a negative book reserve.
Yes, but in terms of theoretical reserve, a negative one would be nonsensical. We're going to hand you the document that was marked while Mr. Majoros was on the stand as Exhibit 766, which is his response to your interrogatory number 700. Got it?
Yeah, I have.
And in that interrogatory, you asked Mr. Majoros to confirm whether or not his proposed theoretical reserve reflects his proposed salvage rates, correct?
That's correct.
Did you submit an interrogatory to the company asking the same question? Asking the company to confirm whether its proposed theoretical reserves reflect its proposed salvage rates. Did you ask the company that question?
I don't recall asking that.
Why didn't you?
Because from their exhibits and work papers, it was obvious that they didn't.
That wasn't the case with Mr. Majoros' exhibits?
I was a little perplexed by it, and that's why I asked the question.
Mr. Majoros' response in this interrogatory was, yes, my theoretical reserves do reflect my net salvage, correct?
Essentially, yes.
The first word of the response is
Yes, yes.
Do you agree with him on that?
No, I don't. Matter of fact, you're cross of him. I did the same math and came up with 0. And when I looked at his exhibits, that's kind of what also triggered me to ask this question, because before, when I looked at his theoretical reserves and compared them to yours, when he takes your salvage out, he came close to the same reserves without any salvage, yours without salvage. So,
Thank you. In your testimony in this case, you're not proposing any changes to the basic principle of determining average service lives and survival curves, correct?
not sure what you mean.
You're not, with regard to average service lives and survivor curve, you're not suggesting that the depreciation study methodology that's been in place for decades be changed, correct?
I guess I'm a little puzzled on what you mean. There's different ways of projecting service lives. And not everybody agrees with that.
People looking at the same information might have a difference of opinion as to what the average service life and survivor curve might be.
That's correct.
But the underpinning of your analyses is the depreciation study that the company performed, correct? That was your starting point?
That was my starting point.
Was that study prepared in a way that differed from the traditional method that's been used for years and years?
Looks similar to other studies I've seen.
The average service lives and survivor curve, that they're inputs to calculating the theoretical reserve, correct?
The average service life and the shape of the curve.
Right.
Was that a yes? Was that a yes?
Yes.
Okay.
And putting net salvage aside for the moment, just thinking about the lives and curves. Once they're established and input into the theoretical reserve calculation, the book reserve is compared to that theoretical reserve to assess whether or not there's an excess or a deficiency, right?
Without the salvage?
With or without.
That's why I was a little confused. You said let's separate it out.
I'll change the question. Once average service lives and salvage factors are established and a theoretical reserve is calculated with or without salvage, the existing book reserve is compared to that theoretical reserve to determine whether there's an excess or deficient book reserve.
Yeah, just I've never seen it done without salvage.
Only if the net salvage factor is 0, correct?
That's rare.
Now that theoretical reserve amount, the way the formula works and the principle is that the lives and the curves that were used to do the calculation assumed that they were the correct lives and curves through all of history, or they should have been. Isn't that how it works?
There's usually based on history and/or judgment going forward, that these are the lives that we believe these assets are going to live going forward.
But the theoretical reserve calculation assumes that they were always the lives and the curves, does it not?
Theoretical reserve, no, it just calculates assuming that you're going to hit that shape and that average service life exactly going forward.
But the theoretical reserve calculation that looks forward assumes that the lives and curves that are being used at this time should have been there, correct? And that's how it knows what
No,
needs to be
it's
done
going
going
forward.
forward.
It's just going forward. Because if you changed it, if you come up with a new theoretical reserve that departs from the past, it may be based on the past, but it's going forward.
Now, in this case, yourselves and a couple of other witnesses are proposing that the method used to calculate net salvage or to determine the net salvage rate to be used in depreciation rates is, you're proposing a method that is not the same that is in use for the company at this time, correct?
That's correct.
And it's a method that, as far as you know, has never been used with respect to the company?
Never been used with respect to Con Edison. That's correct.
The net salvage factor that's determined under whether it be yours or Mr. Arnett's or Mr. Majoris's proposal as to how to do it, that also gets fed into the theoretical reserve calculation, correct? It's a component of it.
Yeah.
Now, that resulting theoretical reserve with a net salvage factor calculated on a newer method, does that theoretical reserve calculation assume that that salvage factor should have always been the one that was used?
It's the one that you're using forward, but it's also the one you're comparing the book to. So if there's any deficiencies or excesses, you're comparing that book to that. Yes.
By changing the method for determining the net salvage percentage, you affect the amount of the calculated theoretical reserve, correct?
You know, whenever you change the salvage rate, you'll automatically change the theoretical reserve.
And that can result, and I think in your testimony, that can result in the decision today that the company's book reserve is significantly excessive, correct?
For which you're saying,
Just in your theoretical reserve variances, or the book reserve variance is very significantly from those of the company, correct?
oh, I wasn't sure. Yeah.
And have you done any study or analysis to determine how much of that difference between your number and the company's number is related to the change in the salvage method that you're proposing?
We did look at the impact on theoretical reserves for for all three companies, yes.
I mean, have you segregated by life incurred versus net salvage? How much of the difference between your theoretical reserves and the company's are due to each one of those?
We ran three scenarios where we used our service lives and used your salvage rates and came up with a theoretical reserve and compared that to the one that we did with changing both our theoretical and our service lives to kind of quantify the difference between our theoretical reserves versus yours, just with respect to salvage, using yours. If we accepted your salvage rates, how much difference is there between the two? That's what we did.
You accepted the company's proposed
No,
net
I said
salvage?
if we did.
Oh, I'm sorry. Okay.
Put a capital I on that.
That's what I thought you meant. Well, how much of the difference between the theoretical reserve you calculate and the one the company calculated is due to the proposed change in method for determining that salvage?
Well, the change in the rates themselves.
Dollars. How about dollars? How many dollars?
I'm not sure I have them with me. I can. They weren't that significant. They didn't dwarf. They didn't like. They weren't the brunt of the punch.
The punch. But if I recall correctly, your calculation and the company's calculation with regard to electric, there was approximately a $300 million difference.
Yeah, and not all. It wasn't like that whole 300 was due to salvage.
Approximately how much do you think?
It was, I think, around a half of that.
Around half of that. So the method that you are proposing be adopted today translates into the company's book reserve that's been developed under another method for I don't know how many decades. It leads you to conclude that the company's recovered too much money from customers over those years, correct?
We've said that they've over-collected this.
And over those years, while the commission was establishing the net salvage factors that the company would be authorized to use in its depreciation rates, was the commission acting unreasonably?
No, the company, the commission accepted either the company or staff's proposals in the past, which were based, in my understanding, on a different methodology.
So that approximately half of the $300 million difference between the company's calculated reserve variance and more is not the result of the commission doing anything that was unreasonable over the years, correct?
Objection. Your Honor, the question is asking the panel to speak for the commission.
You're supposed to say objection before he answers the question.
I tried.
Nothing further, Your Honor.
Do you have any redirect?
Can we have a moment to confer with
Yes, you may.
Well, Your Honor, we have some questions based on the responses to questions.
Okay, let's do those now then.
I just need a moment to...
And please limit it to just what you heard today.
Yes. I just need a moment. Mr. Dickens, I think I heard you say that you disagree with Mr. Majoros' theoretical reserve calculation. Is that correct?
I disagree that there's any impact on the theoretical reserve. Based on your IR response and a similar analysis that I did to the company, I get 0. And as you come up with, negative salvage rates, but for some reason the theoretical reserve does not seem to have those in it.
And, regarding the calculation we performed that's contained in Exhibit 760, do you also have concerns about that?
That's beyond the scope of my testimony.
It's also beyond the scope of the cross. So let's ask another
No
question.
further questions, thank you.
Redirect.
Can we have a moment, Your Honor? Your Honors, we do have a short redirect.
Okay, let's proceed.
Panel, earlier you were asked by Con Edison's counsel whether or not there was anything different in the depreciation study that Con Edison provided, and from which you began the development of your own proposal on depreciation. Could you elaborate on that for a moment?
Yeah, there was one difference from prior Con Edison cases, was that in this case, they actually supplied graphs with visual fits. Before, they didn't have the technology or the ability to do that. In this case, they supplied those graphs.
For the benefit of those of us who aren't depreciation junkies, when you say they provided graphs, these graphs would have shown the actual survivor curves?
Yeah, they're the actual survivor curves with those curves that they tried to fit to those curves. The ones that they were proposing to see how well they fit to the curve.
And how did this affect the accuracy of your analysis?
I used them to help me pick service, pick our own service curve. Well, in matter of fact, in some cases, rather than using pure statistical, sometimes pure statistical curves don't. They may on paper fit well, but when you look at them, they don't really match the curve.
And so by looking at a visual representation of
Objection,
that.
Your Honor. I believe we're going beyond the scope.
Well, I'm not sure how relevant any of this is. Can we wrap this up quickly?
And so by looking at a visual representation of the curves as supplied by the company for the first time in this case, you were able to refine your analysis?
Yes.
No further questions, Your Honor.
Go ahead.
The curves or the graphs that the company provided this time, they were developed on the traditional method of doing a depreciation study, correct? They were just a depiction of the data that otherwise would have resulted.
Well, I'm not the company, so I don't know how much they relied on those to make their decisions.
I'm not asking. You relied on the graphs. Is it your understanding that the graphs were a depiction of the results of a statistical analysis that was performed in the same manner as they traditionally have been?
Oh, yes.
Okay, does that mean that you had, in the past, you had a table of numbers and now you had a table of numbers plus somebody actually plotted it out on a piece of paper.
That's correct.
In the past, if you wanted to, you could have plotted it out yourself on a piece of paper.
Well, in the past, actually, we had to have the company do it because staff doesn't have the programs to do that.
Thank you.
And in the past, they weren't able to do that. They couldn't plot them for staff to see how well they do for it.
Anybody else have everything for this panel? Okay, this panel is excused. Thank you. Next panel is the Con Ed Municipal Infrastructure Panel.
Please. Do you swear or affirm that the testimony you are about to give will be the truth, the whole truth, and nothing but the truth? And do you adopt your pre-filed testimony as your sworn testimony in these proceedings?
Quiet, please.
Your Honor, this panel is ready for cross-examination.
Okay, I believe staff is the only party that's crossing.
Yes, Your Honor. I just need a moment, Your Honor, sorry. Panel, I have a document for you. It's a two-page document. Two-page document. It's the response from the company's municipal infrastructure panel. You vote yourselves to DPS IR number 571. And I ask that this be marked.
Not unanimous. And again, this one says page 1 of 3 and page 2 of 3. There's only 2 pages.
Page 3 of 3 is blank. I have one copy that has all 3 pages you'd like to see.
All right, we'll mark this as Exhibit 768 for identification.
Panel, I just asked, was this response prepared by you or under your direction?
Yes.
And I have another document, which is a number of pages long, forgive me. This is the response to DPS question 775. But again, it has a, the initial pages are pages 1 of 3 and 2 of 3. Page 3 of 3 was blank. And that's the response followed with a number of attachments, which are mostly spreadsheets. No idea how many pages. And if you can turn to page
Hold on. This one's about 1/8 of an inch thick. We're going to mark it as Exhibit 769 for identification.
And if you can turn to page 14, and then we'll leave it up and turn.
sorry, 14 of,
Oh, I'm sorry, it's in the spreadsheets. There's page 1 and so on of 40, and it's page 14 of 40.
Okay, that's up on the top right-hand corner where it says page 1 of 40, and we're on page 14.
And the heading across the top of that page will say Manhattan, I think it's PL, dash 5-year budget. If you look at the, for example, the first six columns, no, I'm sorry, not columns, rows. If you look across to the column in approximately the middle of the page, which says city project date comp, I presume that, could you confirm that the comp refers to completion?
Yes.
And if you look particularly those first 6 rows, the completion dates range from June 2012 and December 2012. Is that correct? And yet, the following column.
Wait, did they answer that one?
Repeat that? I'm sorry. In the column labeled city project date and comp completion, the first 6 rows there have completion dates of. The first 3 are December 2012, and the next 3, oh, I'm sorry, the fourth one is June 2013, and the next 2 are June 2012.
Yes.
And then in the following column, which is labeled 2014, in 2014, in the column in 2014, are those representing company spending or city spending?
You're asking us what the dates represent?
Not the dates, the dollar amounts in the column with the heading 2014.
Those are the estimated company dollars to be spent.
And if the completion date is estimated for December 2012, for example, on the first row, how come the company expects to incur, and could you clarify, is that $800,000?
In 2014, $800,000, correct.
And could you explain why the company is incurring $800,000 on a project that says the completion date is December 2012?
The completion date is the estimated completion date that's provided to the company based on the city's projections, not the actual completion date of the project.
Does the city provide an updated date at some point?
No, they do not. What we know is the duration of the project that we're managing in the field. So we update our forecast based on information we got.
So, just to make sure I'm understanding this correctly, it's July 2013 right now, and the city's provided you a completion date of December 2012, and that's the latest information the city's provided, but the project is still ongoing, is what you're saying?
That's correct.
Okay.
Could the witnesses move closer to the microphone somehow?
No further questions, Your Honor.
Can you redirect?
just one question, Your Honor, redirect. Panel, you were presented with a document that's been marked as Exhibit 768, which is your response to staff question 571. Can you just clarify what you mean when you use the term non-city funded capital projects?
Yes. So for municipal project work, the city provide has both city funds and non-city funds for that work, which is related to interference work, where the company does bear the cost, the interference costs for work performed by the municipality for projects that they receive city funding and non-city funding for. Separate from that, there are also private projects that are not funded by the city. And in those cases, the company does not bear interference costs. Those costs are reimbursed to the company if there are any costs that they bear.
Thank you, Your Honor. Nothing further.
I do have a question, Your Honor. In the past, have there been projects in the city's capital commitment plans for which the company has done interference work, for which some of the funding may have been from non-city sources, for which the company is then reimbursed for the interference work, or for which some other entity pays for the interference work on behalf of the company?
I'm not sure. Can counsel repeat that? There was a lot of parts to that question there. Can you break that up, please?
Okay. In the past, does the capital commitment plan include projects for which the company's interference work would be paid for or reimbursed by another entity, such as the project that involves a private company, private entity?
I'm not aware that the city's capital commitment plan it refers to private work. I'm not aware of that.
For any of the work that the company has done with regard to projects listed in the city's capital commitment plans in the past, has the company received any monies any monies to reimburse the company for the interference work and stuff?
We are not aware that the city has ever included private funds into the city or into private.
So what entities would be included in non-city funding for projects listed in the capital commitment plan?
So in the capital commitment plan, there are city funds and non-city funds for municipal work. So for example, work that's going on in Lower Manhattan today, which is part of the redevelopment, the street redevelopment, one of which will be Broadway that will be starting next month, is almost solely being funded with non-city funds. That is an interference project. The company will bear those costs fully. But it is not being funded with city funds.
No further questions, Your Honor.
Okay, let me see if I got this correct. A private developer wants you to move a line for their private development. They pay the cost, not you. It's not in the city's budget, right?
That is correct.
Okay. If the city wants to put a new street light and tells you to move your line, you pay for that yourself, and the project cost is in the city budget with city funds.
Yes.
Okay. Now, if a private developer wants to put in some big complex, and the city agrees to do highway work as part of the complex, perhaps funded by, partially or all by the private developer, Con Edison has to do the interference work at its own cost, and the city may be using non-city funds to pay for its project. But the city goes out to bid and does the project as a city project in its budget. Is that right?
That is correct.
Okay, thank you. Okay.
Your Honor, just to answer your question, I would simply note that New York City is a little different from upstate communities in terms of the type of developments that might be happening. There aren't like private streets and neighborhoods in New York City such as there are many upstate communities for those types of developments.
Thank you. Okay, the witnesses are excused.
Thank you.
Okay, the DPS Municipal Infrastructure Panel. And we've got 15 minutes across by Con Edison.
The witnesses, raise your right hands, please. All right, we'll do the name tags first.
Yeah, just write your names on there and hold them down so that we can see them.
Any other witnesses that are in the audience, when you come up, please write your name on a piece of paper and put it in front of you so that we know who you are.
Okay, raise your right hands, please. Do you swear or affirm that the testimony you are about to give will be the truth, the whole truth, and nothing but the truth?
Yes.
And you adopt your pre-filed testimony as your sworn testimony in these proceedings?
Panel, it's my understanding that you don't have any corrections to make to your filed testimony?
That's correct. That's correct.
Thank you.
Does that microphone not work? Let's try it then. There it goes, okay.
Judge, I spoke to Jay, and he can't do anything about the microphones until we break.
Okay.
And he has to get in here, do whatever it is he does.
Okay, we'll be breaking after this panel for a 1 hour lunch break.
We'll let him know.
Panel, or Your Honors, the panel is ready for cross.
Thank you. Con Edison.
Thank you. Good afternoon, panel. New York City's capital commitment plan includes information relating to the city's capital projects for the upcoming fiscal year, correct?
Could you
Among the
speak,
projects-
when you're answering, please speak into the microphone and a little louder, okay?
Yes.
And as the previous panel discussed, among the projects listed in the capital commitment plan are projects that are funded from the city budget, as well as projects that are funded in whole or in part from other sources, such as from state agencies, correct?
according to the company's response, that's correct.
On page 9 of your direct testimony, you state that the company's forecast of interference expense is inconsistent with the historic relationship between the company's interference expense and the city's actual expenditures. Is that correct?
Can you repeat again?
Yes, sure. I'm referring to page 9 of your direct testimony. You state that the company's forecast of interference expense is inconsistent with the historic relationship between the company's interference expense and the city's actual expenditures. Is that correct?
That's correct.
And you conclude that the company's forecast is 17% of the city's expected expenditures. Is that correct?
That's correct.
And I'd like to refer you to staff's response to company interrogatory. Con Edison set 3, question 13. These don't need to be marked as exhibits, as an exhibit, Your Honor. These are already included in exhibit MISP-10, but we're circulating copies for ease of reference here.
Thank you.
In this interrogatory, you further explained you further explained your derivation of the 17%, correct?
Correct.
Am I correct that in staff's calculation of the company's rate year forecast as a percentage of the city's expenditures, staff excluded all the projects in the city capital commitment plan that were funded from non-city sources?
That's correct.
Is it staff's understanding that the company does not incur interference costs for city projects listed in the capital commitment plans for which the city receives funds for its work from outside sources?
Well, at that time, staff did pass information through DPS 571. This is some specific project that funded by non-city source. The company responded that they don't know what the source is. So that basically not clear whether those projects are funded by private entities.
But is it your understanding, based on the discussion that we've had here today, and your understanding of how interference costs are incurred by the company, and what costs the company is responsible for, or is it your understanding that the company does not incur interference costs for city projects for which the city receives funds for its work from outside sources?
Can you rephrase the question?
Sure. We've talked a little bit about different kinds of non-city funded projects, correct?
Yes.
Okay. Now, for the non-city funded projects that are what were discussed earlier as municipal work, for which, and I believe the previous panel testified that the company has to pay for those projects. Is that your understanding as well, that the company does have to pay for those for that interference work?
It's not clear whether the city's commitment plan, including private funded project and utility. Yeah, the company kind of just discussed that. But before that, staff wasn't clear whether the city's commitment plan, including private funded project. Because it's not clear how company responds to DPS 571. They did not indicate whether some specific project, non-city funded project, are funded by private entities.
Based on the discussion today,
Yes.
has your understanding
Yes.
changed? Okay. So your understanding is it correct that your understanding today is that the company does have to pay for these projects?
If those projects not funded by private entity, I agree.
Thank you. On page 13 of your direct testimony, beginning at line 20, you note that staff's proposed methodology in this case has been adopted by the Commission in cases 09E 0428, 09S 0794, and 09G 0795, correct?
Yes.
Isn't it true that in each of these cases the Commission also adopted a bilateral reconciliation mechanism?
That's beyond the scope of our testimony.
You are testifying on staff's proposal for interference, correct?
Right.
Are you familiar with staff's proposal regarding reconciliation for interference expenses?
Yes, that's addressed by the staff policy committee.
Do you know what staff's proposal is with respect to reconciliation for interference costs?
Yes.
Okay. So my question again is, are you aware, or isn't it true that in these earlier cases, the ones cited in your testimony, that the Commission also adopted a bilateral reconciliation mechanism?
Could you first tell us what a bilateral reconciliation mechanism is?
Sure. A bilateral reconciliation mechanism reconciles interference costs both above and below the target level that's established in...
Okay, say bilateral, you mean you reconcile up or down regardless of which way it goes?
That's correct, Your Honor.
So it's a reconciliation mechanism. Does it matter whether it's bilateral or not? That's a good question.
Well, it does to the company.
Okay. I mean to the question.
Well, I guess, why don't I... isn't it correct that staff is proposing a one-way down only reconciliation mechanism?
Objection, Your Honor. This is beyond the scope of the panel's testimony. This is a question more aptly directed at the staff policy panel.
I think the witness already said that she knew.
The question is withdrawn, Your Honor. That's, I'm simply trying to... okay. Staff agrees, do you not, that in general, the company's actual interference expenditures are related to the city's actual capital expenditures?
What is the question?
You agree, do you not, that in general, the company's actual interference expenditures are related to the city's actual capital expenditures?
Yes.
And as the city's actual expenditures go up, the company's interference expenditures go up, correct?
In general, yes.
Okay. On page 11, line 17 of your direct testimony, in response to a question regarding why staff believes its proposed forecast of interference expense based on the city's historic average expenditures is reasonable, staff states, quote, the city's capital expenditures fluctuate over time, increasing in some years and decreasing in other years. This is reflected both in the city's published capital commitment plan as well as its actual expenditures. Do you see the language I'm referring to?
Yes.
I direct staff's attention to Exhibit MISP 6. Again, Your Honor, this is already part of the exhibit list, just circulating a copy for convenience. You see the actual fiscal year totals for 2008 through 2012 in the middle of that page? This exhibit shows that the city's actual expenditures over the last 5 years have increased each year. Isn't that correct?
Correct.
Staff forecasted the city's expenditures for fiscal year 2013 as $886 million based on 7 months of actual data, correct? And staff derived this annualized amount by adding up the actual amounts, dividing by 7, and multiplying the result by 12, correct?
Correct.
Has staff been provided with actual city expenditures for an additional 4 months, for a total of 11 of the 12 months of fiscal year 2013?
Yeah, that's correct.
Does this additional information have any impact on staff's estimate for the city's fiscal year 2013 expenditures?
Yes.
Can you please explain what impact it will have?
It's an estimated city actual expenditure based on the information known.
Will it increase your estimate, your original estimate of $886 million?
We don't know this moment because we don't know what actually amount in the June.
But you derived. With respect to actual expenditures for the final month of fiscal year 2013, specifically June 2013, that information is currently unavailable, correct?
Could you repeat your question?
Sure. The actual expenditures for the final month of fiscal year 2013, which is June 2013, that information is currently not available. Is that correct?
That's correct. According to company supplied information in EPS 696.
Okay, you don't dispute that, though. Is that correct?
That's correct.
Well, hold on a second now, then where does the figure 130,000 in this table come from?
I'm sorry, Your Honor. If you'll look at the notes below, Your Honor, the May 2013 and June 2013 forecasts are estimates.
Okay, thank you.
Okay. So I direct the panel's attention once again to MISP 6, which specifically at the bottom half.
Excuse me, I don't mean to interrupt, but I am. There's a note at the bottom that says dollars in millions. And if I'm right, then in 2012, that was $1 trillion. I know Con Edison spends money, but
It should be thousands, Your Honor.
thank you.
Thank you. MISP 6, the bottom half of this exhibit provides a percentage breakdown by month of the city's actual expenditures from 2008 to 2012, correct?
Correct.
And this document indicates that since 2008, the month with the highest percentage of expenditures has been the month of June, with the exception of 2011, when June was tied as the month with the second highest percentage of expenditures, correct?
And here, to be correct.
Does this information have any impact on staff's estimate for the city's June 2013 expenditures?
Yes.
Can you explain what impact that would have?
City's projected expenditure may be higher than staff's estimate, but we don't know how high.
I have nothing further, Your Honor.
Any redirect?
Do we have a moment to confer?
estimate is
Staff doesn't have any regret.
okay. With that, then these witnesses are excused. Thank you. At this time, we're going to take a 1-hour lunch break. So we'll be back here at 2:50. Is that right? We will recommence at 2:50 p.m. Are you ready? Okay, let's go back on the record. Okay, let's try a little harder to speak up this time and into the microphones. I don't know, can anybody hear me? It doesn't even sound like it's resonating. Okay. After reviewing the list of proposed cross, it appears that we have a number of witnesses who can be excused from the hearings. Mr. Bomke has 3 sets of testimony. One is steam, one is gas, and one is electric. The steam and the gas testimony are scheduled for tomorrow, and there's no cross scheduled for him, so I believe we can excuse him for tomorrow.
I was going to ask all my questions and took the stand for the electric.
That would be fine. That would be a good way of doing it. So if we could get an affidavit on those pieces of testimony in hand to the judges at some point.
Sure, yes, I request that you provide it next week, and you would earlier said that was okay.
Thanks, Mike. DPS witness Edmondson and DPS witness Graves. There's no cross for those 2 witnesses as of my current tally. So we're going to excuse those 2 witnesses. Those are scheduled for Thursday, August 1st. And you can give me affidavits on those 2. And the, is it Government Services Administration? Is that right? Witness Goins for Thursday, August 1st. Also, there's no cross for that witness. So that witness can come in by affidavit. Okay? And we'll probably issue a ruling at some point when we get a chance, but I just didn't want people to show up tomorrow and we didn't have to be here. Okay? I had said earlier we might talk about exhibits after the break, but I'm not prepared to do that right now, so we're going to put that off until tomorrow at the earliest. Mr. Lang.
Ask you a quick question on the affidavits. Do you want us to submit them to you or just submit them on DMS?
What I'd like you to do is to send me the original hard copy. Mail it to my office would be the best thing, otherwise hand it to me. And then to submit a PDF copy to the secretary as an exhibit.
Okay.
Your letter should say exhibit so that they hopefully put it into the exhibit category. Otherwise, we'll have to sort it out later on.
Do you want us to wait then to mark them as exhibits or just?
No.
Okay.
No. We will mark them ourselves later on.
Okay.
I'm assuming nobody's going to write me a brief about the affidavits from the witnesses. Okay. So who have we got on the stand here?
You have Mr. Sanders.
Okay.
Raise your right hand, please. Do you swear or affirm that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth?
Yes.
And do you adopt your pre-filed testimony as your sworn testimony in these proceedings?
I do. Mr. Sanders, do you have any corrections to either your direct or rebuttal testimony? No changes. It's available for cross-examination, Your Honors.
Thank you. The only cross I have on my list is DPS. So please proceed.
Thank you, Your Honor. Alan Michaels for staff. Good afternoon, Mr. Sanders.
Good afternoon.
So, as you heard, my name is Alan Michaels. I'll be asking you a few questions. If you would, please turn your attention to page 11, line 4 of your rebuttal. Just so everyone follows, you state, to date, the Federal Reserve has employed 4 rounds of quantitative easing, which have significantly increased the supply of money through the purchase of mortgage-backed and Treasury securities. Additionally, in 2011, the Federal Reserve implemented a plan to flatten the yield curve, i.e. lower long-term rates, by purchasing Treasury bonds with 6 to 30-year maturities and selling bonds with maturities of 3 years or less. Is that accurate read of your testimony?
Yes.
Now, has there been flattening of the yield curve influenced? Has there been a flattening of the yield curve since 2011?
I don't have the figures in front of me, so I can't tell you yes or no whether the yield curve is actually flattened.
So you're unaware whether or not the work that has been exercised by the Federal Reserve has had any influence at all?
That sounds like a different question. It has had an influence, I think. I can't tell you right in front of me. I don't have the figures in front of me to tell you whether it's actually flattening the curve from 2011.
Okay. Has the influence from the actions implemented since 2011 affected the company's decision to issue debt with longer maturities, such as 30 years instead of 10 years in 2012 and 2013?
I think generally the low interest rate environment has attracted us to the long end of the market.
If we were to experience a significantly steeper yield curve in the future, wouldn't the company consider issuing debt with shorter maturities?
The company looks at the market and interest rates when we consider what maturities we're going to issue. So I would say it depends on the particulars of the situation, and I guess the yield curve sequence is one of those considerations.
And in particular, if we were to experience a significantly steeper yield curve, how would that influence the decision of the company then? Would the company look to a longer term, like a 30-year debt?
Like I said, I think it would be one of the considerations that we would look at. We would also look at the depth of the market and the situation in the marketplace at the time as to whether or not 30 years or 10 years is the appropriate, or even shorter is the appropriate maturity for us. Generally, the steepness of the curve and the market dynamics at the time are things that we consider.
Over the past dozen years, has the company's average assets lives materially changed?
I don't know the answer to that question.
You don't know whether the average lives of your assets have materially changed in recent years?
I don't think I've testified to that. I don't have that in front of me.
So, over the past 8 years prior to 2011, did the company find it best to issue both 10 and 30-year obligations?
I can't answer that question. We've issued maturities, different maturities at different times, but I can't answer as to whether that was best.
Do you know what you issued at that time?
Which period are you talking about?
8 years prior to 2011.
I'd have to look at the maturity schedule and what we issued in those years. Subject to check whatever we issued in those years, whatever maturities they were. I guess I'll stipulate to what's in our portfolio right now.
Or are you aware in 2009 the company also issued 5-year debt?
I can remember that.
Turn your attention, please, to page 11 of your rebuttal testimony. You note on line 17 that interest rates will rise once the Federal Reserve begins to taper off its easing policy. Is that your testimony, sir?
Yes.
And when will that occur?
We don't exactly know, but I think it has already begun. We believe it's already begun.
And in your opinion, is it going to be gradual and incremental or sudden and dramatic?
I can't say that.
Will interest rates stop rising once the labor market has improved substantially and presumably the Fed's accommodative monetary policy comes to an end?
I can't tell you that either.
If you would, please turn your attention to page 12 of your testimony, line 11. You refer to staff's testimony and state staff itself has alluded to the likelihood of interest rates rising in its testimony. Is that correct?
Yes.
Then you quote from page 44 of staff's testimony. When the federal policy does invariably change, we can logically expect these rates to go higher. Is that your testimony?
That's the quote from, I guess, staff's testimony.
Thank you. But based on the totality of staff's testimony, do you accept that staff was actually referring to federal policy which held short-term interest rates at historically low levels?
I'm sure I understand the question.
Sure, that staff was referring to short-term interest rates at historically low levels as opposed to long-term rates.
That was not my understanding. My understanding was that they were making a statement about interest rates in general.
Turn your attention, please, to, actually, excuse me, in February 2013, the company issued $700 million of 30-year unsecured debt at 3.95% interest. Is that correct?
That's correct.
And is it correct that the yield required by investors as measured by the required spread to a comparable maturity treasury security was 88 basis points?
That's correct.
Judge, at this time, I'd like this document marked. It's
You could identify it for the record, some kind of description.
it is a 10Q from the company. It's there's one entire document and there's copies of one page in particular. If the witness has the full document, there's a second copy.
When you say it's a 10Q, what does that mean in English?
It's a quarterly report, Judge.
Submitted to who?
Yeah, FCC. SEC, excuse me.
Okay, so it's a FCC Form 10Q report.
Is this 770?
Hold on. Did you say SEC?
Yes, SEC.
I almost wrote FCC there by mistake.
I'm sorry. Can I continue?
Hold on.
Sir.
Okay, this one-page document will be marked 770 for identification.
Thank you. Mr. Sanders, turning your attention please to page, strike that, let me first ask, are you familiar with this document?
Oh, yes.
And do you know what it is? Can you explain?
Let's see. It is the Consolidated Edison Inc. and Consolidated Edison Company of New York's 10Q quarterly filing, date ending March 31st, 2013.
Thank you. And turning your attention to page 21. Are you familiar with that page?
Can't say I'm intimately familiar with it. I recognize the table.
Okay. And what does that table mean to you? What is it?
It says it displays the regulatory assets and liabilities of the company.
And based on the document before you and your knowledge as treasurer of Saccone, are you aware in less than 2 months after Saccone's debt issuance noted previously, in April 2013, a subsidiary of Con Edison Development issued secure notes with a weighted average life of 15 years at a stated cost rate of 4.78%?
Was the question, am I aware of that?
Yes.
Yes, I am.
Is it correct that...
Before you go on, can you identify what the difference is between Con Edison and Saccone?
Judge for me?
Anybody? Are they both the same company, or is one a holding company or the other? Okay. So just explain on, if you could, witness, on this page. Why does it say Con Edison for 2 columns and CECONY for the other 2 columns?
I would assume that Con Edison on the left is Con Edison Inc., the holding company, the parent. Saccone is Consolidated Edison Company of New York, the regulated utility.
Thank you. That's what I wanted to know.
And Mr. Sanders, is it correct that the yield required by investors for the competitive subsidiary, as measured by the spread to a comparable maturity treasury security, was more than 200 basis points?
Subject to check, I would have to say yes, but I would clarify that it wasn't the Con Edison subsidiary, Con Edison Development. It was a project underneath Con Edison Development, which has security related to it. So it's a secured financing for a project that sits underneath Con Edison Development.
Now, you mentioned subject to check. What is it that would help you?
I don't have the spread right in front of me, so based on my recollection, I think it sounds reasonable.
I don't like subject to check. I hate to have you go home with homework. Could I give you something that you can check today? If I were to give you a printout from the Federal Reserve, would that assist you?
I'll have to look at it.
So, Mr. Sanders, the last page is what's important. Does that assist in giving you spreads?
Can you ask me the question again? What spread are you looking for?
Sure. The question was, is it correct that the yield required by investors for the competitive subsidiary as measured by the spread to a comparable maturity treasury security was more than 200 basis points?
I think I can agree that that's true, but this document doesn't help me at all.
Okay, thank you. And thank you, Mr. Sanders, and thank you, judges. Nothing further at this time.
Excuse me, Mr. Michaels, were you going to mark that last one, or was that just to refresh your recollection?
No, it was unnecessarily marked.
Can you redirect?
Just have a second, let the witness room.
It is.
We have no redirect, Your Honor.
Thank you. Mr. Sanders, thank you. You're excused.
Your Honor, at this time, we'd like to call on Mr. Hebert.
Raise your right hand, please. Do you swear or affirm that the testimony you're about to give is the truth, the whole truth, and nothing but the truth?
Yes, I do.
And you adopt your pre-filed testimony as your sworn testimony in these proceedings?
I do.
Now, Your Honor, we had previously circulated a list of corrections to the testimony of Mr. Hebert, and this was to your rebuttal testimony?
That is correct.
And would you like me to briefly summarize those for the record?
Has the list made it to the Secretary's office?
Yes.
Then no.
Excellent. Mr. Hebert is available for cross-examination, Your Honor.
Okay.
Your Honor, my name is Jason Gray on behalf of the County of Westchester. I'm coordinated with UIU with respect to cross-examination of Mr. Hebert, and I will go first. That's okay?
That would be fine.
Good afternoon, Mr. Hebert. How are you?
I'm well. How are you doing?
Doing well. Good. Could you please turn in your direct testimony to page 45, where you begin your discussion of flotation costs?
Yes, I have that.
Am I correct that both you and County of Westchester witness Charles King propose adjustments to recover flotation costs in this proceeding?
We do.
Turn ahead a couple of pages to page 49 of your direct testimony.
Yes.
You propose a 3 basis points adjustment to reflect flotation costs. Is that correct?
That is correct.
You state at page 49, line 8, that calculation is shown on pre-filed exhibit RBH7. Do you see that?
I do.
Could you please turn to that exhibit RBH7? Which for the record, I believe it's been identified as exhibit 443.
Yes, I'm there.
Look on page 1 of that exhibit. The top 3 lines under company data, it say Consolidated, Edison, Inc. Do you see that?
I do.
Sticking with those first 3 lines, do you see the column heading completion date?
I do.
Can you please explain what time period the completion date covers with respect to Consolidated, Edison, Inc. in this exhibit?
2007, roughly 2007 through October 2010.
If you could stay on that same page in those 3 lines at the top, go over a couple of columns to the heading total flotation cost. Do you see that?
I do.
Is it your position that the total flotation costs shown on that exhibit for Consolidated Edison are listed in those 3 lines for the periods, for the period of 2007 to 2010?
I'm sorry, I'm not quite sure I understand your question. Let me be clear on what those flotation costs are. They are the direct costs of issuing the stock for those 3 discrete issuances.
Thank you for that clarification. So those, the $3 amounts listed there, those are the portion of the shareholders' original equity investment that was used for equity issuance-related costs from 2007, or to cover those costs from 2007 to 2010. Is that correct?
Well, let me phrase it the way I would, which is to say that these are the costs associated with issuing the stock, underwriters' discounts and other direct costs that were not available to the company in order to fund its investments in its rate base.
Thank you. Do you agree that if I were to sum those three lines, that the total flotation cost listed there would be $5,873,224?
That looks about right.
Subject to check. If we were to hold all else equal, isn't it true that adoption of your 3 basis points adjustment for flotation costs would permit the company to earn approximately $5.8 million in just 2 years?
No, let me explain the fundamental difference between, pardon me, Mr. King's approach and mine. My approach says, as I said earlier, these funds will never be there for the company. The company is financing its long-lived assets with equity. But because of flotation costs, the equity is not there. The equity is perpetual. It stays on the balance sheet forever. And in that respect, the company has to be able to recover its costs in perpetuity as well. That's the basis of my calculation. It's not an amortization calculation similar to Mr. King's.
And I appreciate that. I just am asking you, is the practical effect of your 3 basis points adjustment, would that allow the company, holding all else equal, to earn approximately $5.8 million in 2 years?
I'll tell you, I've not done the math, but when you say allow, again, in my view, this is a cost that the company is incurring and should return. Excuse me, and should earn.
I believe it was just 2 answers back. You mentioned that these costs, I believe you mentioned this, let me know if this is accurate, these costs occur in perpetuity, is that right?
No, that's not correct.
Could you explain what you said?
Sure. The costs occur once, but the equity is long-lived. The equity is there effectively in perpetuity. And so the reduction to equity likewise is perpetual in nature.
You recently testified before the Maryland Public Service Commission in case number 9311, did you not?
I did.
Am I correct that in case 9311 before the Maryland Commission, you calculated a flotation cost adjustment?
I did.
Are you aware of whether County of Westchester witness Charles King also testified in case number 9311 before the Maryland Commission?
I'm sorry, I didn't mean to speak over you. Yes, I recall that he did.
Do you know whether Mr. King also calculated a flotation cost adjustment in that proceeding?
Your Honor, I object. What happened in Maryland has no relevance to this case. And I would ask that we move forward to subjects that are actually of interest to us.
Well, it has relevance if they were testifying to the same issue in another case. So I will let this question stand.
I'm sorry, I didn't hear.
Overruling the objection.
I'm sorry, can you repeat the question?
Yes, I was just asking, are you aware of whether County of Westchester witness Charles King also calculated a flotation adjustment in case number 9311 in Maryland?
I believe we did, yes.
Am I correct that on July 12, 2013, the Maryland Commission issued its order in that proceeding?
It was recent. I don't recall the exact date.
Your Honor, at this time I would like to mark an exhibit. I believe it would be Exhibit 771. It's a 2-page document. It's an excerpt from the Maryland Public Service Commission's July 12, 2013 order in case number 9311. And it's the portion of the order discussing calculation of flotation cost adjustments.
Got that?
You see on the first page?
Hold on a second. We don't have them yet.
Sure.
You're more important.
It's just 2 pages?
Yes, this is just an excerpt, but the order is in excess of 150 pages, I believe.
We'll mark this as Exhibit 771 for identification. Okay, now you may proceed.
You see on the first page of this exhibit the case number 9311?
Yes.
If you please turn to the second page, the first full paragraph. In particular, I'd like to turn your attention to the sentence that says, "We decline to accept Mr. Hebert's recommendation that Pepco receive flotation costs amounting to 14 basis points, as his calculation is based on his premise that equity and the cost behind it have an indefinite life." You see that?
I see that.
Is
I
it your
know
understanding that the Maryland Commission did not accept your premise and therefore your resulting calculation of the flotation cost adjustment?
it is. It's also my understanding that the Minnesota Commission has accepted my approach.
Do you see the reference in that first full paragraph to OPC?
Yes, I do.
Is it your understanding that OPC refers to the Office of People's Counsel?
It is.
And is it also your understanding that OPC is the entity on whose behalf Mr. King submitted testimony in case 9311?
It is, and again, Mr. King, I don't believe, was involved in the case in Minnesota where the commission adopted my methodology.
Perhaps he should have been.
Your Honor.
Yeah, just keep the questions.
Sure.
Do you have a citation for the other case?
I can get that for you, sir.
Move on to a different topic. If you could turn, the remainder of my questions will focus on your rebuttal testimony. If you could turn in your rebuttal testimony to page 28, line 16. Particularly, this is where you discuss staff's criticism of your proxy group screening process. Do you see that?
I do, yes.
If you move over to page 29, beginning on line 10, you discuss using median results and how that can mitigate the effect of statistical outliers. Do you see that as well?
I do.
The sentence that ends on line 16 of that same page, you provide a cite, which is footnote 46, to a decision from the New Hampshire Public Utilities Commission. Do you see that?
I do.
Did you provide in this proceeding a copy of that decision to any parties?
I don't know if it was included in work papers, but certainly would be available if someone would ask for it.
It's a publicly available decision.
It is, yes.
Let's move on. If you could turn to page 92 of your rebuttal testimony.
Yes, I have that.
Particularly the subject heading application of the constant growth DCF model.
Yes, I do.
And that discussion covers 2 pages, right? 92 and 93?
It does.
Could you please focus on page 92, lines 19 and 20, where you testify that Mr. King excludes results that were unreasonably low based on a threshold of 200 basis points above the current yield on Moody's BAA bonds. And to support your testimony, you cite page 25 of Mr. King's direct testimony, correct?
Yes.
In fact, if I could just back up a second, if you look at these 2 pages, there are 5 footnotes listed, and just with respect to the testimony, you're referring to pages 24 and 25 of Mr. King's direct testimony. Is that right?
That is correct, yes.
Do you have a copy of those pages of Mr. King's testimony with you?
I should.
I have an extra copy of it now.
Yes, I'm there.
I'll have some questions in a minute on those, so just keep those handy.
Yeah,
Maybe
I'll
keep
flip
a
back
finger
and
in
forth.
each.
Okay.
If you could turn over to page 93 of your rebuttal testimony, line 6, you testify, Mr. King provides no empirical evidence to support his assumption that 200 basis points above the current Moody's BAA bond yield, i.e. his 6.74% threshold, is a reasonable and appropriate benchmark for that purpose. Do you see that?
I do.
Keeping a finger there and flipping over to Mr. King's testimony, is it your understanding that beginning on page 24, line 23 to page 25, line 14 is where Mr. King discusses that lower bound threshold?
I'm sorry, could you repeat those?
Sure,
lines
please
for
slow
me?
down.
I apologize.
Page 24, line 23, I believe.
Yes, I
That's
see.
the last line, to about page 25, line 14.
Yes, I see.
Those are, that's the portion of Mr. King's testimony you were referring to in
Yes.
general. Do you see footnote 12 in Mr. King's direct testimony?
I do.
Would you agree that footnote 12 is a citation to an administrative decision of the Federal Energy Regulatory Commission?
Yes, I would agree with that.
Your Honor, at this time, I would like to mark another exhibit. It is a two-page exhibit, which is the company's response to County of Westchester interrogatory number 47.
That'll be marked 772 for identification.
May I proceed, Your Honor?
Yes.
Mr. Hebert, do you recognize this response as one in which you sponsored the answer?
I do.
I'd like to point out in the middle of the first paragraph, which is the question, parts A and B ask, does an administrative agency decision constitute empirical evidence, as that term is used in the quoted testimony? And then does the analysis underlying an administrative decision constitute empirical evidence, as that term is used in the quoted testimony? The quoted testimony is page 3 of your rebuttal testimony, lines 6 to 8. Do you see that?
I do, yes.
Now I'd like to point your attention to the second header, actually the third header indicating response. It's the second bold response. And it's at the bottom of page 1, and it continues on to page 2.
Yes, I'm with you.
And it states, whether a specific administrative agency decision or the underlying analysis supporting an administrative decision would constitute empirical evidence supporting Mr. King's proposition that 200 basis points above the current Moody's BAA bond yield is the lower bound of reasonable cost of equity estimates, depends on the context and content of that decision and or analysis. Mr. King has not provided an administrative agency decision or the underlying analysis supporting such a decision for Mr. Hebert to assess. You see that?
I do.
Wasn't it true that, just like you cited to the publicly available decision from the New Hampshire Public Utilities Commission, Mr. King cited to the publicly available Pioneer decision in footnote 12 of his testimony?
That's correct. They're two separate issues as far as I'm concerned.
But your answer says he did not provide an administrative agency decision to assess. And in fact, he did provide a decision. Isn't that true?
I'm sorry, can you point me to the words again? Oh, I'm sorry, there it is. That's true. Yeah, I'll leave it at that.
Mr. Hebert, did you prepare this interrogatory response? It doesn't say who prepared it on its face.
It was, either I prepared it or it's prepared under my supervision.
Thank you.
Your Honor, at this time, I would like to mark another exhibit. It is a 3-page exhibit, which is an excerpt from the testimony of Mr. Hebert in FERC docket number ER11-1915.
That'll be 773 for identification.
Mr. Heather, do you recognize this exhibit as an excerpt of the testimony you filed on October 27, 2010 in Federal Energy Regulatory Commission docket number ER 11-1915?
I do.
Could you please turn to page 3 of this exhibit and confirm that the Pioneer transmission case you cite on on line 9 is the same Pioneer transmission case that Mr. King cites on page 25, footnote 12 of his direct testimony?
It is, yes.
Isn't it true that in this Federal Energy Regulatory Commission proceeding, docket number ER 11-1915, you applied FERC's 100 basis point lower bound?
Which, in the context of market conditions prevailing at that time, that's correct. The issue, of course, is whether or not a lower bound should stay the same depending upon the market conditions, depending upon the level of interest rates. I've got a lot of discussion in my rebuttal testimony and some in my direct regarding the fact that the equity risk premium moves inversely with the level of interest rates. That's my view with respect to empirical analyses. It's important to take those conditions and that relationship into consideration.
Mr. Hebert, do you know how many companies Mr. King eliminated from his analysis based on his 200 basis points lower bound?
Not offhand.
Would you accept, subject to check, that it was only one and that that analysis can be found on exhibit CWK-2 at page 2? And for the record, it is exhibit number 362.
I'm sorry, CWK2, page 2 of 7?
At page 2, yes.
Schedule 2. And I'm sorry, your question again?
Yes, my initial question was, do you know how many companies Mr. King excluded based on the application of his 200 basis points lower bound?
It would appear, well, it appears as though it's one.
And that's Consolidated, Edison, Inc., is that correct?
Yes, that's correct. Now, of course, the extent to which you're going to exclude something on a lower bound is made by reference to the actual estimates themselves. A lower estimate is at issue between Mr. King.
Excuse me, I didn't hear just the last
Mr.
part.
King and I disagree as to what constitutes a reasonable return on equity estimate.
But you do agree with Mr. King that there should be a lower bound, correct? You just disagree as to what the level should be?
I do agree there should be a lower bound, and I also believe that that lower bound has to be established within the context of prevailing market conditions. I talked a minute ago about the inverse relationship between interest rates and the equity risk premium. That's an important consideration as far as I'm concerned. The other important benchmark, I believe, is the prevailing level of authorized returns, something that we've seen in staff's testimony as well. So I do think that there are observable benchmarks that can be used as a measure of the lower bound of reasonableness.
I'd like to mark another exhibit. This is a one-page response to the County of Westchester interrogatory number 41.
We'll mark that 774 for identification.
Yes, I have.
Mr. Howard, do you recognize the response to County of Westchester interrogatory number 41 as one with which you prepared the answer?
I do.
In the first paragraph, the question is, what should be the lower bound of cost of equity estimates for Consolidated Edison, CECONY? your answer is the 10.10% recommended ROE is Mr. Hebert's estimate of investors' required return for the company. Do you see that?
I do.
Now, your return on equity recommendation would violate your criterion, right? Because your ROE recommendation is based on an average.
I am just not following you.
Sure, let me try again. Your return on equity recommendation is based on an average of, in part, on an average of observable returns. Is that correct?
My return on equity, the 10.1% is based on the average of the two discounted cash flow models, the two capital asset pricing model results. Those two are average and applied to the 2/3, 1/3 weight. Does that answer your question?
Not exactly. Maybe I'm not being clear. If the lower bound is the same figure, the same percentage as the utilities recommended return on equity, which is an average, doesn't that mean that there are inherently return on equity estimates that are lower than the utilities recommended return on equity?
I have to say, I'm not sure I think we're still crossing each other, but one thing I would say is that if an average is based on a number, perhaps there are numbers that are lower, there also would be numbers that are higher. But I'm still not, I'm sorry, we still seem to be missing each other on this one.
I think that's fine. Let me see if this will clarify. Is it your position that the lower bound should be the company's recommended ROE position?
In this case, where the commission has set by precedent an approach, a formula, the estimate is the estimate. It's the estimate based on the average of the individual results, which thereby are weighted. I will tell you that in other cases, for example, you referred to case 9311 in Maryland. There is no such formulaic approach there. There, you look at the range of results, or at least I do, and establish a lower range by reference to things like the level of authorized returns, the level of interest rates, the movement of the equity risk premium with respect to the level of interest rates. So there, where the selection of the return on equity is a function of many variables as opposed to one that's set by formula, there the selection of a lower bound becomes the more relevant issue.
In this proceeding where there is a formula, is your position that the company's recommended return ROE should be the lower bound?
I still am not getting it, but what I would say is that in other proceedings, again, you referred to the case 9311 in Maryland. The recommendation there was 10.25%, higher than the 10.1% recommendation here. The issue, of course, again, that by convention, followed the commission's grading approach.
Do you know what the resulting return on equity in the case number 9311 was?
9311 was 9.31%.
Your Honor, at this time, I just have 4 interrogatory responses that I would like to mark, and I don't have any particular questions on them.
Were they prepared by this witness?
I believe they were. I will ask him that.
Okay.
In particular, they are responses to County of Westchester interrogatories number 34, 35, 37, and 40. And Mr. Heber, once you receive those responses, if you could just take a minute to look at them.
I will.
Sure. Okay, were these 4 documents prepared by you or at your direction?
Yes, sir, they were.
Okay, good. We will mark response to question number 034, Exhibit 775 for identification. 035 will be Exhibit 776 for identification. 037 will be Exhibit 777 for identification. And 040 will be 778 for identification.
With that, I don't have it. Can you repeat what
Sure. Number 34 is 775. Number 35 is 776. Number 37 is 777. And number 40 is 778.
$41?
41 is Exhibit 774. That was marked previously. Okay, that ends the cross by UIU and Westchester. Is that correct?
No, just Westchester.
I think you said you were coordinating.
No, we had coordinated as to who would go first.
Oh, okay. That's not much coordination. All right, Westchester, it's your turn. I'm sorry, did I get that backwards? UIU's turn. Sorry.
Who's up, Your Honor?
Mr. Rigbert?
Yes, Your Honor. We're still trying to deal with these exhibits that came off. Different order. Can you go through the numbers again?
You want the last 4 or do you want more than that?
It's the last 4.
775 is number 34, 776 is number 35, 777 is number 37, and 778 is number 40.
Thank you. Good afternoon, Mr. Hatter.
Good afternoon.
My questions are going to focus on pages 80 and 83 of your rebuttal testimony.
I'm sorry, 80 through 83?
Well, 80 and 83.
80
And
and
we'll
80.
start with 80 on, starting on line 15. We state, in addition, in chart, as shown in charts 9 and 10, Mr. Copeland's average long-term growth rate of 4.32% is far below historical measures of GDP. Nonetheless, Mr. Copeland provides no explanation as to why investors would expect long-term macroeconomic growth to be nearly 33% below its long-term average. Do you see that?
I do.
And could you point to where in Mr. Copeland's testimony that he represented his average long-term growth rate of 4.32% as what investors would expect for macroeconomic growth or growth in GDP?
The section here refers to the terminal growth rate. second stage growth, which in my view is best represented by long-term growth in GDP. Now, substantial deviations from long-term GDP growth are what I have in mind. If GDP growth really is the measure of terminal growth over the long term, and it's a measure which is accepted by others that I've cited, then substantial deviations from long-term GDP growth as the measure of terminal growth ought to be explained.
But in fact, did not Mr. Copeland testify quite clearly in his direct testimony that an average long-term growth rate for utilities should be less than what investors would expect for long-term economic growth or growth in GDP?
Sure, but here, what I say in lines 17 through 19 is, why would they expect it to be 33% less?
Didn't Mr. Copeland provide an explanation for that in his direct testimony?
Mr. Copeland suggested it should be lower, but in my view, that's a very substantial difference.
Okay. Turn to page 83 of your rebuttal testimony. Beginning at line 1. You cite the Duke CEF survey as reporting a standard deviation of 6.60% for the 6.7% estimate of the expected return on the S&P 500 for the next 10 years. Is that correct?
It is.
I'd like to show you a document. This is a one-page document that has as a heading on top of the page, Duke CFO Magazine Global Business Outlook Survey -US second quarter 2013. Mr. Hedrick, would you agree that you supplied this document in response to UIU information request number 300?
Yes, we did.
All right, are we marking this?
Yes, Your Honor.
Or is it already,
marked for identification.
is it already in an exhibit that's been pre-marked?
This is provided in response to an IR request.
Okay, so. All right, this will be marked one-page exhibit 779 for identification.
And Mr. Hubbard, would you agree that what you marked in yellow and green, or what you see here marked in yellow and green, you marked in your response?
Yes.
Now, earlier you stated that your estimate of the expected market return was within 2 standard deviations of the 6.7% reported in the Duke CFO survey. Is that correct?
That is correct.
And would you also agree that 2 times 6.6 is 13.2?
It's a big range. That's the point.
Now, 13.2 on either side of 6.7 gives a range of -6.5 to plus 19.9. Would you agree with that?
I would agree with that.
So the range of 2 standard deviations around the 6.70% estimate of the expected market return is minus 6.5 to 19, positive 19.9.
Sure, and let me explain why I chose to talk about this.
I'll get to that.
Oh, okay, okay.
Is it your testimony that any number within this range is a reasonable estimate of the expected market return in the S&P 500?
Now I'll get into what I was going to get into, if that's okay.
But just say,
Your Honor, could you please let the
Yes.
witness answer the question?
Yes, I would like to do that.
Thank you.
You have to look at this document in its totality. You have to look at the minimum, the maximum, and you have to look at the way the question is worded. You see that 95% CI, 95% confidence interval. That is calculated as the standard error. It is the standard deviation divided by the square root of the total number of observations. That's why you have such a small range. You see that 6.0 to 7.4. That range is calculated by reference to the standard error, not by reference to the standard deviation. But when you look at the minimum and the maximum, going from negative 14 to positive 100, and you read the question says, over the next 10 years, I expect the average annual S&P 500 return will be. It doesn't say whether it's the arithmetic average. It doesn't say whether it's the geometric average. It doesn't say whether it's the total return. It doesn't say whether it's capital appreciation. When you look at the minimum, the maximum, the total range, you look at the ambiguity in the question itself, I don't think that 95% confidence interval, which is calculated by reference to the standard error as opposed to the standard deviation, is a relevant metric. That's why I put in my testimony the reference to the standard deviation.
Okay, so then your answer to my question was no or yes?
My answer to your question is that this is an extraordinarily broad range of results. And if you look at it with respect to the standard deviation, it's very wide. And in terms of the standard deviation, it would be a wide range of results. I don't think the standard error is the appropriate range, and I don't think the 95% confidence interval calculated by reference to the standard error, because of the way the question is worded and because of the range, is the relevant metric.
When you speak about the way the question is worded, is that the question in your testimony?
No, the question on page 37. Over the next 10 years, I expect the average annual S&P 500 return will be. What are we talking about? Arithmetic average, geometric average? Are we talking total return, or are we talking capital appreciation? I'm assuming they're talking in nominal terms, although it's quite possible it could be in real terms. There's inherent ambiguity in the question, which to me helps explain that wide range of negative 14 to plus 100. There are other things here. We don't have the measure of skewness. We don't know whether the distribution is normal or not. It's just a very difficult data set to take any comfort, to me, in that 95% confidence interval of 6 to 7.4%.
Turning to on pages 83 of your testimony, lines 4 and 5, you say, that is, even based on the Duke CFO survey results, my estimate of the expected market return falls within the 95% confidence. You see that?
Correct. By reference to the standard deviation, not the standard error.
Okay, so looking back at what's been marked for identification as Exhibit 779.
I'm sorry, I didn't write that down. Is that the...
37, page 37.
Sorry, yeah.
Thank you.
37. So do you see where next to the 6.6 that you highlighted in yellow, that there's a range of 6.0 to 7.4 highlighted in green?
Yep, I see that.
And now look at the column heading above the 6.0 to 7.4 range, also highlighted in green. What does that say?
That is what we were just talking about. That's the 95% confidence interval calculated by reference to the standard error. And you can go through the math. If you take 6.6, which is standard deviation, you divide that by the square root of 336, that will give you the standard error. If you then take that mean, 6.7, plus or minus 1.96 times the standard error, will give you that range of 6 to 7.4.
Okay, now, your estimate of the expected return on the S&P 500 was 13.1%, is that correct?
That's about correct, yes.
Okay. And that is almost twice the upper end of the 95% confidence, or the CI of 7.4%, is it not?
Again, calculated by reference to the standard error, but given the ambiguity in the question, given the range of the data, I don't think that is the valid range.
But you don't agree that's the valid range?
Well, that's what I've been saying. Yes.
Sorry, I just can't hear.
Yes. I'll just go through it real quick one more time. That 95% confidence interval is calculated by reference to the standard error, which is not the same thing as the standard deviation. The standard error is calculated as the standard deviation divided by the square root of the number of observations. So in this case, it's 6.6 divided by the square root of 336. That 95% confidence interval, therefore, assumes a normal distribution, which means that 95% of the observations would be within 1.96 standard errors in this case. That gives you that range of 6 to 7.4. My point has been that the range is extremely wide, a minimum of -14, a maximum of 100. We don't know the other moments of this distribution. We don't know whether it's skewed, we don't know whether it's peaked, we don't know whether or not it's normally distributed, and therefore would lend itself to the calculation of a standard error. I think that in large measure that range has a lot to do with the ambiguity of the question itself. And so I don't think that that 6.0 to 7.4 is the relevant measure of the expected range of the market return. I think more likely it's measured by reference to the standard deviation.
Now, also, staying with that same exhibit, do you see the figure of 10.8% highlighted in green?
I do.
And what are the words written to the left of that 10.8?
Well, the question says, this is the question in the survey, over the next 10 years, I expect the average S&P 500 return will be, there is a 1 in 10 chance it will be greater than, the mean result was 10.8%, the standard deviation was 8.6%.
So you're saying that that chart does not say that there's only a 1 in 10 chance that the market return will be greater than 10.8%?
What I'm saying is that that is the average result. But again, look at the mean, look at the minimum, look at the maximum, look at the question itself. Look at the question is open to interpretation as to what average we're talking about, arithmetic versus geometric, what measure of return we're talking about, capital appreciation or total return. And with that ambiguity and given that wide range, again, I think you can look at the mean, but looking at the 95% confidence interval, which here again is calculated by reference to the standard error as opposed to the standard deviation, would suggest to me too narrow a range.
So wouldn't that analysis also apply to your estimate? And wouldn't you agree that the chances that are 9 out of 10 that your estimate of the market return is wrong?
I just want to be sure I understand your question. You're suggesting that a survey result somehow is analogous to the analyses that I performed?
Based on this document that you provided us, response in an IR,
I would say this.
Level of 95%.
I would say that when I look at my expected market return, It's highly consistent with what has been observed over the past. It's consistent generally with what staff calculated in terms of its measure of the expected return. And so I'm comfortable with mine.
No further questions.
DPS staff.
Thank you, Your Honor. Good afternoon, Mr. Heather. My name is Alan Michaels, and I'll be asking you a few questions. Let me start by apologizing in advance. I know at some point I'm going to call you Mr. Hebert. If you'll excuse me, I've been reading your testimony with that in mind, so I know it'll come up.
Believe me, it's been Hebert, it's been Hebert, in Vermont it's been Hever. It doesn't
Now, during your cross-exam with Westchester, I heard something that was also mentioned in your testimony. You stated that you prefer, for a return on equity approach, more of a holistic look of recent and substantial market changes, not a simple formulaic approach. Is that correct?
I think it's important to take into consideration market conditions in a current market where we've seen a fairly substantial run-up in interest rates in a relatively short period of time. I think that's a consideration, yes.
Now, in fact, that's even in your rebuttal testimony of page 11, starting at line 7, but in particular, line 11, you state to include recent and substantial market changes. Is that correct?
I'm sorry, which page?
1111.
Oh, I was on 711.
So page 11, line 11.
I have Slurpees and burritos on my mind, apparently. Yes, I have that.
Now, when you performed your ROE analysis, then you took into consideration such recent and substantial market changes. Is that correct?
Well, let's back up. When my recommendation is based on the 2/3, 1/3 weighting, it's based on the approaches, the discounted cash flow, the capital asset pricing model, the empirical capital asset pricing model approaches accepted by the Commission in the past. Now, we certainly have some differences as to the application of those approaches. But when I look at the issue of market conditions, to me it's a step back sort of issue. Does the recommendation, do the results make sense in the context of a market in which the yield curve has shifted upward, where forward interest rates have shifted upward as well? I think those are important considerations. Now, I recognize that in the past the Commission has used a formulaic approach, which does not necessarily lend itself to looking at ranges within that algorithm. But I do think it's important to look at the eventual results because of differences in the applications and determine whether or not they make sense in the context of prevailing market conditions.
So just to be clear, understanding you find it important to take into consideration those recent and substantial market changes, is that what you included within your ROE analysis?
I guess not to be too picky, but I guess the question becomes what we mean by ROE analysis. My analysis are based on the methods, and that has been used by the Commission, and again, we all know we have differences as to the applications of those methods. But in the end, I applied the weighting factors and did not create a range of results, which I may have done, which I often do in other proceedings. The range of results lends itself to thinking about market conditions and where your return may be. With this approach, there is no such range. So again, my view is that I look at the data, I look at the recommendations, and knowing that there are differences in the application of the models, I ask myself, does the result seem to make sense on its face in the context of the market?
Thank you. And you used your approach, as you just described, in not only your original analysis, but also your updated ROE. Is that correct?
Yes, it's correct.
And including these recent and substantial market changes, your updated ROE analysis resulted in a lower ROE estimate than your original analysis, is that correct?
That's exactly right. And that result, when you look at the fact that the market has changed, you have to ask yourself, what caused the interest rates to increase? What caused changes in dividend yields? Is it likely or is it possible that growth rates are expected to catch up with them at some point? And could that decrease really be a disconnect in timing? So I do think those are important considerations.
Thank you. Sir, turning your attention now to page 21 of your rebuttal. Starting on line 3, you state, Mr. Henry uses the 20-year Treasury yield as the capitalization component of his CAPM analysis. Is that correct?
Well, this was one of those corrected. So it should say the risk-free rate component of this CAPM analysis.
Okay. But the 20-year Treasury yield was not something that was corrected?
That is correct. If that is correct, it was not correct.
Thank you very much for the clarification. Now, continuing with your rebuttal testimony, you disagree with Mr. Henry's use of the 20-year Treasury yield. Is that correct?
In my view, the 30-year Treasury yield is the appropriate measure.
If I could please turn your attention to page 31 and 32 of Mr. Henry's pre-filed testimony. What Treasury yield or yields did he use in his analysis?
I'm sorry, repeat again?
31 to 32. It's the end 31 and 32. Yeah, line 24 of 31.
Right. He uses the average of the 10 and the 30. There is no issued 20-year Treasury bill, and so you have to interpolate the two to arrive at the 20-year Treasury bill rate.
Thank you for that. And sir, turning your attention to page 40, line 17 of your rebuttal, you state, it is also interesting to note that the June 2013 Value Line Investment Survey's forecast for real GDP growth for 3 to 5 year projection period is 3.20%. Is that an accurate read of your rebuttal?
It is.
Your Honors, if I could now have a work paper, please, if I could have this marked as an exhibit for identification.
Whose work paper is it?
The witnesses, Your Honor.
Does he work for Value Line? How is this a work paper?
It was in the work papers that were submitted.
Okay, so it's a source that you used?
Yes, sir.
Including your own. We'll call this 780 for identification.
Thank you. And again, Mr. Heather, thank you for that clarification as well. So, are you familiar with this document?
I am.
And what is it?
It is Value Lines Investment Survey, Issue 3, dated June 2015.
This was included in your work papers for this rate case, was it not?
Correct.
And Your Honor, this time I would move to have this entered into the record.
We're not doing that today.
Also,
It's been marked for identification.
Yeah.
We are going to take objections to all exhibits and all testimony after the close of the hearings in writing. And then after we see what people have written, we will move everything into evidence ourselves.
Now, if I could hand you, I'm going to give you the color copy, and unfortunately I only have black and white here, so I'm going to give everyone else black and white, which is a bit more difficult to read. So, Mr. Hever, I'm now handing you what has been previously marked as CEH3. And Your Honors, does this need to be marked again as an exhibit?
No.
Are you familiar with this document, sir?
Yes, sir.
And what is this?
This is one page out of the Blue Chip Economic Indicators report as of March 2013.
Now, if I can have you look at Exhibit 780, the value line document from your work papers, can you confirm that the 3.2% real GDP growth rate estimate is for the period of 2016 to 2018?
It is.
Does the value line provide growth estimates beyond its 3 to 5 year projection period, in this case 2018?
No, it does not.
Now, please review CEH3, the Blue Chip Economic Indicators forecast. What is the real GDP growth rate estimate for the period of 2015 to 2019?
For the period 2015 to 2019?
Yes.
Well, there's 2016 to 2019. Well, so you want to go by year? So it moves from 3.1% to 2.6% over that period, 2015 through 2019.
And continuing to review CEH3, the Blue Chip Economic Indicators forecast, what is the real GDP growth rate estimate for the period of 2020 to 2024?
2.5% is the consensus.
Thank you. Mr. Hebert, would you be able to describe in general terms a trend in the unemployment rate over the past 3 years?
Generally, the unemployment rate has been falling.
A downward trend, is that fair to say?
Fair to say.
And still generally, as the economy expands or gets back on its feet from a low point, is it true that unemployment will decrease?
I think as a general proposition, unemployment generally defined would decrease. You often hear discussions about various measures of unemployment. The U6 rate, which includes workers who choose to not go back into the workforce underemployed, and there's questions as to what will happen there. But I think as a general proposition, as the economy improves, the unemployment rate will fall.
And at some point, as the economy continues to expand, will unemployment reach a point where it has little room to fall? In other words, unemployment will plateau at some point, even though the economy continues to expand. Is that fair to say?
I think there's, in the economic literature, there's lots of discussion about the natural rate of unemployment. I'm not quite sure I can tell you what that is right now.
If unemployment rates were to stop falling and level out, what sort of impact would that have on GDP growth?
I think the causality implied by your question is kind of interesting. I think unemployment might be seen as a function of GDP growth and perhaps not the other way around.
Yep. Understanding that there are other factors, still generally speaking. If the unemployment rate stops falling and were to plateau, as we discussed, would it cause GDP growth to tail off even though the economy continues to expand?
If you realize that GDP growth is a function of consumption and investment and government investment and savings and net exports, net imports, I think that's difficult to say.
Turning your attention, please, to page 40, line 13 of your rebuttal.
Yes, I have that.
Great, thank you. You state, well, it is true that 2024 is the farthest date in the Blue Chip forecast. There is no reason to assume that GDP growth would remain unchanged for the remaining 189 years. Is that an accurate read of your rebuttal?
It is.
Mr. Howard, I'm going to give you the nice colored copy of what's been marked as previously CEH 16. Everyone else is getting one page from it. And then we want the entire document, there's one extra copy, black and white.
Do you want to mark this one?
It's previously marked as CEH 16, Judge.
Okay.
Mr. Hebert, are you familiar with this document?
Yes, I am.
And what is it?
This is the Energy Information Administration's annual energy outlook for the year 2013.
And this was also an exhibit used by Mr. Henry, is that correct?
That is correct.
If I could, please turn your attention to page 92. I put a little marker there. Table 8. Would you please explain what this table shows?
This is it's labeled comparison of average annual economic growth projections for the years 2011 through 2040, and it provides various sources of projections. The AEO, which is the Annual Energy Outlook, Global Insights, Office of Management and Budget, Congressional Budget Office, and others.
In fact, as you said, there are a number of projections. How many organizations are represented here that have forecasts for average annual real GDP growth from 2011 to 2040?
There are 9.
And of those organizations, do you see any forecasts for average annual real GDP growth that range from 2.4% to 2.6%?
Yes.
Approximately how many?
All 9.
Now, sir, turning your attention to page 49, line 19 of your rebuttal. You cite Roger Moore, is that correct?
I do.
Are you aware whether this is the same Roger Moore who has appeared as a witness for this same company in prior rate cases and has testified on behalf of the company?
I assume it to be.
You quoted this prior witness stating, "It is useful to remember that eventually all company growth rates, especially utility service growth rates, converge to a level consistent with the growth rate of the aggregate economy." Is that an accurate read of your rebuttal, sir?
It is.
Now, are you aware of the basis that Roger Moore used to conclude that this is, quote, especially true for utilities?
No, I read his site, but I will tell you that the use of nominal GDP growth as a terminal growth rate, as I go on to say with respect to Edison, is not an uncommon assumption.
Thank you, Mr. Hebert. If I could turn your attention to page 106 of your rebuttal. Starting at line 10. You state, "While it is true that too much leverage will degrade credit quality and increase the cost of debt, it is also true that incremental financial leverage increases risks to equity investors and therefore increases the cost of equity." Is that correct?
That's correct.
So to paraphrase, correct me if I'm wrong, is it your position that incremental differences in leverage are important when analyzing a company's ROE?
My view is that as leverage gets added, and as you start adding leverage beyond what may be considered to be industry practice, then you are adding leverage, you are adding financial risk, and to the extent you add financial risk, you increase the cost of capital, both debt and equity.
Sir, yet on page 103, line 17 of your rebuttal,
Yes.
you state, "The fact that Saccone has an excellent business risk profile and a significant financial risk profile does not distinguish the company from the other utilities in Mr. Henry's group." Is that an accurate read of your rebuttal?
It is.
Are there incremental differences between the credit ratings of Saccone and your proxy group?
If your question is, do the proxy companies have, excuse me, different credit ratings than Saccone, the answer is yes. That, of course, is a measure of the cost of debt as opposed to the cost of equity, but the answer is yes.
Are there incremental differences between the credit ratings of Saccone and Mr. Henry's proxy group?
Again, when you say incremental differences, there are differences between Saccone and the companies helping from the proxy group, yes.
Is leverage a basic component of credit quality?
Leverage is a component. It's one of many.
And turn your attention, please, to page 110 of your rebuttal, lines 3 through 5. You state, "As I indicated below, it is quite clear that the extent and nature of the non-utility operations vary greatly from company to company. That does not mean, however, that their capital structures are universally improper, as staff suggests." Could you please point out where staff suggests that capital structures are universally improper?
The staff suggestion that any company with what staff considers to be too much leverage in unregulated operations is improper. And I believe we actually asked a discovery question to that effect.
Did you receive a response that leads you to the
It did, and I wish I could recall the discovery question offhand.
I see you looking at papers. I don't want to rush you. Are you?
No, I don't recall the discovery offhand.
Would you have page 20 of staff's capital structure direct testimony on you?
I do.
If you could turn to that, please. Isn't it true that the panel points to recent research that, quote, confirms the contention that utility holding companies generally capitalize their riskier, unregulated businesses with common equity ratios that, based upon the riskiness of these investments, are insufficient relative to the equity ratios employed by utility subsidiaries. Is that correct?
That's correct.
And turning your attention to page 55, this time of your direct testimony. I think it's a bit tough. You noted RRA's regulatory evaluation of New York as an average 3. Is that correct?
I'm sorry, I'm just getting it.
Yes. Okay.
Yes.
So it actually starts on 54, it starts really at the top of 55.
I'm with you.
Are you aware that on April 16th, 2013, RRA updated its state regulatory evaluations? I mean,
I'm not
Simon
sure.
Dance.
It's always Simon Dance, but I don't recall the exact date of the update. I've no reason to doubt that.
Well, again, I don't like the whole concept of subject to check. I'd rather have us both be sure. That's why we're here. So if I can, tell you what, I'll give you the color copy once again. Judge, if we could mark this as exhibit, please. Sure.
could you just give me a brief description of the exhibit?
Sure, Judge. It is Regulatory Research Associates, Regulatory Focus, State Regulatory Evaluations dated April 16, 2013.
That we marked Exhibit 781 for identification.
Thank you. And Mr. Everett, turn your attention to Exhibit 781. Are you familiar with this document, sir?
Yes, I am.
And what is it?
This is Regulatory Research Associates Report of State Regulatory Evaluations dated April 16, 2013.
And according to RRA, what rank was New York assigned in its April 16, 2013 regulatory ratings?
I bet you can give me a hint as to where I can find that.
It is near the bottom of page 1. You can see at the end of the last sentence of that paragraph.
Yes, thank you. On April 16th, which of course was after I filed my direct testimony, was upgraded from average 3 to average 2.
Thank you. Now, this was after your direct, but it was before your rebuttal, is that correct?
Correct.
So New York's ranking has improved, is that correct?
According to RRA.
Thank you. And Mr. Everett, thank you for your time. I have nothing further. Thank you.
Have one group question.
Okay, we're going to do redirect.
Mr. Hedrick, during your cross-examination, you were asked a number of questions regarding GDP growth. Do you have any additional observations you'd like to share with us regarding that subject?
I do. What we're focused on here is estimating the long-term rate of nominal growth in GDP beginning 10 years from now. So the question is, basically 10 years from now, what do we think the market thinks nominal GDP growth will be? That means including the effect of inflation. The numbers that we were talking about and looking at earlier this afternoon were measures of real GDP growth, that is, without respect to the effect of inflation. Now, many things can happen to increase inflation. Historically, the rate of inflation has been 3 to 3.3%. My estimate of inflation has been about 2.5%. If in fact the actual inflation wound up being equal to the historical level of inflation, then even if real GDP growth is lower, nominal GDP growth will be higher. It's the interaction between real GDP growth and inflation that we're focused on here. And so while there are other estimates of real GDP growth, when we look at what may happen to inflation over time, higher levels of inflation could very well result in higher levels of real GDP growth, again, based on investors' expectations beginning 10 years from now.
I have no further questions.
Nothing further. Thank you, Judge.
Okay, this witness is excused. Mr. Carley, your next witness.
Your Honor, at this point in time, I'd like to call company witness absent.
Do you swear or affirm that the testimony you are about to give will be the truth, the whole truth, and nothing but the truth?
Yes.
And do you adopt your pre-filed testimony as your sworn testimony in this proceeding?
Yes, I do.
Your Honor, for the record, we would like to take a moment to point out one correction that needs to be made to the witness's testimony. Is it true, Ms. Lapson, that the reference in your rebuttal testimony to Exhibit EL-12 should be rather to EL-13, and that occurs on pages 14, 35, and 37 of your rebuttal testimony?
Correct. And on the exhibit itself, the number should appear as EL-13 instead of EL-12.
Aside from that, do you have any other corrections to make to either your direct or rebuttal testimony?
No.
Thank you. Ms. Lapson is available for cross-examination.
Thank you. Staff?
Thank you, Judge. Good afternoon, Ms. Lapson. My name is Alan Michaels. I'll be asking you a few questions. In your update, you provide testimony regarding recent changes to Section 25A of the Public Service Law. Is that correct?
Correct.
In fact, your update starts, if I'm correct, on page 5 and ends on page 15 of your document. Is that correct? That was your update/rebuttal testimony?
Yes.
And out of those 10 pages, 9 were devoted to 25A. Is that correct?
I would have to check, but I recall that approximately page 5 to 11 is what I recall. But I have to check.
Do you have it with you? Would you like to
I
check?
do. Starts on page 5. Goes through page 13.
So that's
on page 5 of page 13.
Out of a total of 15.
Yes.
So would you agree that's a
That's a
majority?
major item of my, I would say that is a major item of my update.
Thank you. So is it your position that because there are stricter statutory penalty provisions for gas and electric corporations, the Public Service Commission should take this new risk into account when determining a proper return on equity for Sicconi?
I strongly believe that this has moved the risk that was faced by the company relative to that which was present before.
And ma'am, you state that the new provisions in law will, quote, undermine investor confidence on page 9, line 21 of your update, is that correct?
Yes.
25A is an enforcement statute with penalty provisions for combination gas and electric corporations, is that correct?
Yes, that's my understanding.
And the combination gas electric corporations are subject to penalties under the statute for violating regulatory law, is that correct?
They are subject to penalties for certain types of performance defects, as I understand it. Certain types of for failing to comply with the provision of the public service law.
Okay. So for failing to comply with the public service law, is that correct?
Correct.
So if the statute is for penalties, wouldn't the best way for a company to avoid any impact from 25A would be not to commit any bad acts that are punishable?
That would be a good strategy.
Thank you.
However, in the normal course of events, many things happen which may turn out to be not in compliance, and that is a normal event that does occur. So companies are subject to penalties from time to time or commit actions. And in this case, the consequences of those have been greatly increased.
With regards to the impact of 25A upon the confidence of the investor, wouldn't an investor look to the company's quality of management to minimize exposure to an enforcement statute?
Certainly, companies utilize their best efforts to avoid failure to comply with the law.
Are you aware of any incident where the commission held a company accountable for something outside the company's control?
I am not at the moment, I don't have access to those records.
Now, Your Honors, I recognize this is a public document, but this is for convenience. I'm going to be handing out a copy of the 25A. Here, please give one to the witness. Now, ma'am, within your updated testimony, you note Sicconi's financial exposure to 25A, is that correct?
Correct.
And this is specifically noted on pages 7 and 8 of your updated testimony, is that correct?
Correct.
If you would please review paragraph number 3, line 5 of the statute of 25A.
I'm sorry, paragraph,
3, and then if you would count 5,
is this number 3?
it was paragraph number 3.
Number 3, yes.
And specifically,
I'm sorry, I'm confused. What's the numerical designation that you're referring to?
it is paragraph number 3 of 25A. And the 5th line in it states, not including taxes paid to and revenues collected on behalf of government entities. Do you see that, ma'am?
Yes, I do.
Now, when you estimated the company's financial exposure to this enforcement statute, did you take into account that paragraph 3 that has the language stating not including taxes paid to and revenues collected on behalf of government entities?
I would have to look back at my work papers. I don't have that work with me. I can check that.
Please do.
I mean, I can't check it here. I can check it afterwards.
I understand. So what's problematic is, Your Honor, are we going to leave a hole in the testimony until we receive the homework back from this witness?
Well, it doesn't sound like you have an alternative at the moment, so why don't you try to work around it?
If I can give you approaches in a different way, I used my best efforts based upon publicly available information to calculate what I thought might be the financial impact. So that was what I did. I did what any financial analyst or securities analyst would do. I utilized data that was available from public sources and made a calculation. And the calculations that I made were fairly broad. They were approximations.
Okay, and when you made those broad calculations, you don't recall today, though, whether you included this exception that is in a public statute.
I am aware of this exception. I read this. I had this document in front of me when I did the work, so it is my belief that I reflected that I exceeded that in my calculation. But I'm not capable of checking this number.
Your Honor, just so that we're clear, is the staff's position that the numbers included in Ms. Lapson's testimony are high, if you will, because they include taxes paid to and revenues collected on behalf of government entities? Is that the point?
That is correct.
Okay, and the witness said she could check that and give us an answer, so.
And I can correct it with those numbers and
Let's hear back from the witness one way or the other through a communication
Sure.
from
We can
counsel.
certainly circulate an answer.
Thank you. Thank you for your ability to return on that. Thank you, Judge. On page 27 of your rebuttal, line 15, you state that staff witness Mr. Henry fails to adequately address, let alone refute, I'm going to paraphrase here and say your argument, I believe you said my argument, that the Commission's rate-making practices cause Saccone to experience weaker cash flow than the rate-making policies and practices used by other state regulatory jurisdictions. Is that your testimony?
yes, it is.
I'm going to hand you what has been previously marked as CEH 18. Ms. Lapson, are you familiar with this document?
Mr. Craig Henry's exhibit. Yes.
Thank you. And would you agree that this document, CEH 18, compares Saccone's financial performance to all operating companies for which financial data was available on Capital IQ?
That's not obvious from the lack of footnotes or attribution on this exhibit.
But ma'am, you did see his work papers, is that correct?
Yes, Mr. Henry did send me his work papers, which clarify that.
All right, thank you. And so based upon that clarification, is it true then that this document is a comparison? It compares Saccone's financial performance to all operating companies for which financial data was available on Capital IQ.
That is what I believe to be the case. I did not check it myself, but I received some work papers.
Can somebody tell me what Capital IQ is?
They're owned by Standard. They're owned by Standard & Poor's, and they report data that many witnesses rely on. I believe Mr. Hebert also relies on it as well.
Okay, so it's a Standard & Poor's report of some kind. Thank you.
It's an alternative. I utilize SNL to report similar types of financial data. My schedules were based on SNL data, and apparently the staff uses Capital IQ.
Thank you.
And Ms. Lapson, from CEH 18, did the company's financial performance exceed that of its peers in some metrics, yet in others it fell slightly below its peers? Is that correct?
I'm not sure which metrics you wish to comment. Because the page would be very, very small numerals. It's really taxing my ability to respond to it.
comparison on the 10-year average, 2003 to 2012, do you see that line? It's green.
Let me address this in a different manner.
Well, I'd ask you to answer the
it says,
question.
please use, it says, I said that Sacconi's cash flow financial ratios are weak as compared to those of a broad sampling of peer utilities. And I utilized in my testimony cash flow measures. What I see in this page are a number of measures, very few of which are cash flow measures. I only see FFO to construction expenses, not really a measure of their performance, but that is the only thing I can see here that refers to cash flow. I believe that what I was calling attention to was the fact that whatever measures witness Henry used, they really are not cash flow measures. He responded to my data based on cash flow measures, which were cash flow from operations, and instead he gave back a set of measures which are largely accrual income data measures, not cash flow measures. And that's the point that I made. So if you ask me, is there a page of non-cash flow measures that appears to show a superior performance, I say it doesn't prove anything relating to cash flow. And so I think you perhaps may have misinterpreted my response.
Except, ma'am, I think you're misinterpreting my question because that had nothing to do with the question that was presented. So again, do you see the green?
Can you talk on the microphone, please?
Certainly. Do you see the green line?
Do you see either column is highlighted in green?
Okay, thank you. Now, that is the 10-year average for 2003 to 2012, is that correct?
2003 to 2012. 10-year average, yes.
And if you compare the EBIT interest coverage, it's at 3.57%, is that correct?
You think that's Sacconi?
Yes.
Yes.
And compare the Sacconi 3.57% to the EBIT interest coverage for the industry median. Do you see that number?
Yes.
And what is that?
3.52.
Thank you.
And are you purporting that that is a cash flow measure?
Ma'am, I'll be asking the questions.
Uh,
No, we have nothing further, thank you.
Can you redirect?
Just give me a second.
I thought she was doing pretty good on her own.
We have,
Thank you. Thank you. You're excused. Okay, it's time for DPS staff to call the capital structure panel.
Yes, staff calls the capital structure panel.
You can remain standing. Raise your right hand. Do you swear or affirm that the testimony you will give today is the truth, the whole truth, and nothing but the truth? Yes, I do. And do you adopt your pre-filed testimony as your sworn testimony in these proceedings? Yes, I do.
Are they available for cross?
One question, please, Your Honor. Panel, have you had any updates to your testimony?
No, we have not.
Thank you. Your Honor, they are now available for cross.
Okay. Con Edison.
thank you, Your Honor. I am Jack Hurley. I'm going to pose a number of questions to you based upon your testimony that you submitted in this proceeding. Turn to page 6 of your direct testimony. The company in these rate cases is proposing a common equity ratio of 50.24%, correct?
That's correct.
And staff, in contrast, is recommending its usual 48% common equity ratio in this case?
Staff is recommending a 48% equity ratio.
Objection, Judge, as to the term of usual.
Isn't one of the major reasons that the company currently has a common equity ratio of 50.24% and projects a similar common equity ratio during the rate year due to the change in the federal tax depreciation rates commonly referred to as bonus depreciation?
Yes, I would say that bonus depreciation led to the company having a higher equity ratio than should be allowed.
Due to the additional cash generated by bonus depreciation, the company was able to issue less debt and increase its retained earnings, correct?
Yes.
In addition, as discussed in the company accounting panel's direct testimony, the company has deferred for the benefit of customers the carrying charges resulting from the cash flow benefits received from bonus depreciation. That's correct, isn't it?
I'll have to take your word for it. I'm not that familiar with the accounting panel's testimony.
Oh.
I didn't prepare it.
This is the company accounting panel testimony.
I didn't hear your comment, I'm sorry?
This is the company's accounting panel
Yes.
testimony. Yes.
I'm not intimately familiar with the company's accounting panel testimony.
Is it correct that the company could have opted out of the bonus depreciation program?
Again, I'm not an expert in bonus depreciation, so I really am not qualified to answer that question.
So then you couldn't tell me that by agreeing to participate in the bonus depreciation program, customers benefit?
I'm not an expert in bonus depreciation. I think that really is more of a question for our accounting panel. I am a little familiar with bonus depreciation, and I know how it affected the company's equity ratio.
Thank you. On page 19 of your direct testimony, you state that because of their low business risk nature, utility companies are generally able to employ significantly higher levels of financial risk than their non-utility counterparts for a given credit rating. And then, is that correct?
That's correct.
And then on page 20, you go on to make the point that it is common industry practice for utility holding companies to capitalize their riskier, unregulated businesses with more equity than is deployed on the balance sheets of their utility operating company subsidiaries. Is that a fair reading of your testimony?
I would say it is.
As a general matter then, all else being equal, in order to maintain the same credit rating, a company with greater business risk would need to have a larger equity cushion than a similar company with less business risk. Is that correct?
I would say that's true, yes.
In your direct testimony, you discuss both business risk and financial risk, don't you?
I do.
On page 18 of your direct testimony, you refer to Standard & Poor's assessment of business risk and how it uses 6 distinct financial risk profiles. Is that correct?
Yes, it is.
Is it fair to say that any risk assessment of the company by S&P is based on past events rather than projected events?
I would say that they take into account historical data and anticipate the company's, what's going to happen to the company in the future.
It's true, isn't it, that regulatory risk is considered to be a component of business risk?
That is true.
And regulatory risk would include such things as changes in laws and regulations or decisions by regulatory agencies that will materially impact a business, sector, or market?
That is true, material impact, yes. But when it comes to the utility industry, that's doesn't generally happen.
Whether it happens or not, it's...
I guess let me clarify. I guess my point is that the utility companies are regulated, so they're at very minimal risk. So it's unlikely that any laws would detrimentally hurt them.
Are you familiar with the Section 25A that was discussed at length with some of the company's witnesses?
Yes, I am.
Would you say that that has potential to have an impact on the company?
I would say it doesn't.
It does not?
I would say it doesn't.
The fact that the commission, without having to go to court, can revoke all or a portion of the company's franchise doesn't constitute a material regulatory risk?
Well, that just leads me to ask myself the question as to what kind of punishable acts the company is going to commit. Otherwise, I would say if it's business as usual, I wouldn't suspect that 25A would have any implication on the company.
Let me ask you this. Is it fair to say that investors would consider potential loss by utility of their service franchise to be a regulatory risk?
Explain what you mean by potential loss. What kind of
The fact
potential loss are you talking
the fact
about?
that is set forth in Section 25A, the commission can revoke all or part of the company's service franchise.
I can't speak for the commission, but I can't imagine the commission would willy-nilly just penalize the company for no reason. That's
I'm
what
not-
you're getting at.
Trust
Maybe
me,
I'm
I'm not-
misunderstanding you.
The question is, would the investor consider the potential that the commission can revoke all or a part of the utility service franchise to be a material regulatory risk?
You know, 25A has, I think, was put into law several months ago, if I'm not mistaken, and I don't think investors have reacted to that as of yet. So, I mean, I guess it's a possibility in the future they could, but right now I don't think that it really is that much of a factor. I don't think investors really factor that in.
Isn't it possible that some investors, in light of that lack of a track record, might consider this to be a matter of concern?
When it comes to Saucony, I really don't. That's my opinion, that I really don't.
Is it fair to say, for instance, that the final order issued by the commission in these rate proceedings involves some degree of regulatory risk for Con Edison?
Yes, I would say so.
When you were preparing your testimony in this case, did you have the opportunity to review the testimony of other staff witnesses in these rate cases?
I did review some other staff witnesses' testimony.
I'd like to ask you a few questions about that. Are you aware that the staff accounting panel is recommending the elimination of the reconciliation of property taxes during the rate year?
Again, not intimately familiar.
Wouldn't the elimination of that reconciliation expose the company to additional risk, specifically the risk that the property taxes paid by the company during the rate year would be greater than the amount included in rates?
I think that's more of a question for our accounting panel, but I would say that, yes, it does pose a risk. I mean, although one of the many risks, so it's not a
Yes,
risk.
we'll get to some of those risks.
Okay.
Are you aware that the staff accounting panel is proposing to impute during the rate year a total of $6.5 million in cost savings related to Project One?
Not familiar with Project One. Sorry, that's more towards our accounting panel.
As a general matter, wouldn't this imputation expose the company to additional risk, specifically that the company will not be able to realize those savings during the rate year?
Judge, if I object to this time, the witness has already stated this is better for the accounting panel. I don't see why there's a continuing question when she just said she doesn't know.
Well, I think, Your Honor, as a general matter,
She's doing fine. Let her keep going. She's answering it the way that she thinks she needs to answer it, and as long as we keep moving, it's okay.
In the context of the whole accounting panel testimony, I can't really tell you what risks are greater. It's just, I didn't prepare the accounting panel testimony, so I really can't speak to
that's fair.
the risk involved.
Are you aware that the staff policy panel is recommending rejection of the company's proposal to reconcile the O&M expense associated with the Pipeline Safety Act of 2011?
Again, not familiar, didn't prepare the testimony.
Are you aware that the staff policy panel is recommending rejection of the company's proposal to establish storm reserve accounting for its gas and steam services?
I didn't prepare the testimony, sorry.
As to the company's existing storm reserve accounting for electric service, are you aware that the staff policy panel is recommending both the implementation of a first storm deductible as well as a new limitation that only those expenses incurred in the 30 days following restoration of the ability to serve all customers would be eligible for deferral?
I'd have to take your word on that subject to Jack. Again, I did not prepare that testimony, so I'm not familiar with that subject.
Judge, at this point, unless the company is planning on accepting all of our testimony, I don't really see how this witness can be questioned on it.
Well, the witness is talking about risk and the impact of risk on the company. And Mr. Carley is identifying a number of things that he believes are risks in the staff position. And I think it's fair for him to ask whether or not the witness who testified about risk factored those things into her analysis. So I'm going to let the questioning proceed.
Thank you, Your Honor. Are you aware that the staff depreciation panel recommends reducing the company's proposed electric depreciation expense by approximately $120.6 million, gas depreciation by approximately $18 million, and steam depreciation expense by approximately $2.7 million, respectively?
I did not prepare the testimony.
As a general matter, to the extent that the staff's depreciation panel's proposal is accepted by the commission and depreciation expense is reduced by those amounts, wouldn't that adversely affect the company's cash flow?
I'm sorry, can you repeat the question?
I mentioned briefly the staff depreciation panel's recommendation to reduce depreciation expense for electric, gas, and steam. My question is, would the implementation of this proposal by the commission adversely affect the company's cash flow, in that it would be an expense it wouldn't be able to cover?
I'm not a depreciation expert, so it's really hard for me to say. So I really don't know what to tell you. I didn't prepare the testimony. I'm not intimately familiar with depreciation. I guess it would have some kind of effect on the company's cash flow and depreciation rates, but I'm no depreciation expert.
Is it your understanding that the company's cash flow has been weak cash flow has been a matter of concern for the rating agencies?
I know that the rating agencies are well aware of the company's cash flow.
And that they view it as being weak?
I know at times it's been considered weak.
Are you familiar with the ongoing commission proceeding, case 13E-0140, in which the commission is considering the development of a utility scorecard which could be used as a tool for the assessment of New York State electric utility performance in restoring power to customers after a significant outage?
No, I'm not. I wasn't assigned to that case.
Are you familiar with the Commission Case 13M-0061 involving customer outage credit policies and other customer protection policies related to prolonged electric and natural gas service outages?
Not intimately familiar. Again, I wasn't assigned to that case, so I can't really speak to it.
Just by way of information, that proceeding staff has proposed to exclude from the revenue decoupling targets, and therefore not allowed to be recovered, the volumetric portion of delivery bills that was not collected from customers who were out of service more than 3 days, as well as the loss of revenues from customer charge credits.
Judge, objection at this point. I'm not sure who's testifying.
It's starting to get repetitive. I think you made your point. She's looked at very broad risks and hasn't looked at specific ongoing proceedings that may affect the company. So
As long as we have that understanding.
I think you made your point well, and so let's move on.
On page 45 of your direct testimony, you state that you do not recommend continuation of the current policy of the true-up of the company's long-term debt securities, nor do you recommend the true-up of any debt that the company may refinance during the rate year. And as I understand it, the basis for this position is that the interest rates on long-term debt securities have stabilized considerably over the past couple of years, and these rates can be projected with somewhat relative certainty. Is that correct?
That is correct. Short-term interest rates on long-term debt have stabilized over the past several years.
It is unclear the extent to which the Federal Reserve will continue to intervene in the financial markets to keep interest rates low. Isn't that true?
That's true. It's anyone's guess as to when the rates may increase. It may be a year from now. No telling that it's going to be anytime soon.
And it's just this uncertainty that has helped cause the rise in interest rates as well as interest rates volatility over the past few months?
There was a little blip, I know from the Fed's announcement, but I believe it's just a little blip and it's not going to increase for the long term. My personal opinion.
Did you get one?
No, if you want.
Here to you.
Now, Your Honor, I passed around a one-page document setting forth information that comes from the Federal Reserve's website. Specifically, it compares the market yields for both 10-year and 30-year Treasury securities between April 30, 2013 and July 15, 2013. I'd like to have this one-page document marked as an exhibit.
It'll be marked Exhibit 782 for identification.
Now, panel, have you had an opportunity to look at this?
I'm reviewing it right now.
Thank you. This exhibit shows, does it not, that the market yields on 10-year Treasury securities have increased between April 30th, 2013 and July 10, 2013 by 100 basis points?
Yeah.
Similarly, this exhibit shows, does it not, that the market yields on 30-year Treasury securities have increased between April 30, 2013 and July 10, 2013 by 80 basis points?
They have increased over the past several months.
Now, on page 40 of your testimony, you discuss the company's forecasted cost rates for its proposed new debt. And the company projects cost rates for its two issuances during the rate year. Is that correct?
Correct.
In contrast, staff uses the most recent actual Treasury yield based on staff's view that short-term movements in long-term interest rates are difficult to forecast. Is that correct?
Staff does believe, we believe that the current actual yield is the best estimate for the future.
Isn't this position of staff's fundamentally inconsistent with staff's position that there is no need to true up of the company's long-term debt securities or any debt that may be refinanced during the rate year, since interest rates on long-term debt securities have stabilized considerably over the past couple of years, and these rates can be projected with somewhat relative certainty?
Judge, objections before. I think there's like 3 questions there.
Why don't you see if they can answer it?
I prefer she didn't. That was very convoluted. Break it up.
Just try one more time, but let's try not to object as to form unless the witness has an objection as to the form. Okay? Make it a little simpler if you could, Mr. Brown.
I guess my question is there not a fundamental inconsistency in staff's position? On one hand, that there's no need to true up long-term debt securities or any debt that may be refinanced throughout the rate year, with the position that you've taken that the most actual you start again. On one hand, you suggest that you need to use the most actual treasury yield for purposes of the company's debt issuances that were made during the rate year.
I think you mean most recent actual.
I'm sorry?
Most recent actual.
Yes,
Okay.
because interest rates are difficult to forecast.
Okay.
On the other hand, you're suggesting that in terms of the company's debt that may be refinanced, there's no problem with forecasting interest rates because they've stabilized.
You just asked me about a long-term debt and then the refinanced debt?
Yes.
Two separate questions? I'm not following you right now. Because I don't see the inconsistency in my testimony.
Why is there no inconsistency?
I believe that the latest known is the best measure of a future rate. That's what we believe is the best. So I don't see where you're implying it's inconsistent. I wasn't following you.
I lost your train of thought too.
Yeah.
It didn't sound like the two things were inconsistent.
On one hand, staff is saying that they have no problem, that there's no need to true up because the company, in terms of its long-term debt securities, has the ability to, because the market is stabilized, to predict accurately what's going forward in the future. On the other hand, they're suggesting that they need to use most current rates because they have difficulty in forecasting.
Well, that's not really what I'm saying. What I'm saying is the current actual is the best estimate for the future. And when you're talking about the volatility in the rates, I mean, we're not seeing volatility in debt markets like we saw in 2008 after the fall of Lehman. So, yes, long-term debt can be predicted with long-term debt rates can be predicted with somewhat certainty because it has stabilized. And over the rate year, we don't see rates going sky high. So, I'm still not following
Well,
what
you're saying that are you suggesting that rates have stabilized even though, as shown in Exhibit 782, rates have increased by 100 basis points in just a few months?
Well, yes, you're just showing me a 3-month time period, but over the course of the past couple of years, yes, rates have stabilized considerably.
I have no further questions on that.
We need that.
Thank you, Your Honor. At this time, we do have a couple of questions for you, Direct.
Okay, proceed.
Panel, with regards to the discussion of 25A, do you have an opinion regarding whether or not it creates a new risk for the company?
Yes, I don't believe that it creates a new risk. My belief about 25A is if the company breaks a rule, they should be held accountable. They should be held accountable for its actions, and that's nothing new.
So when you said the company should be held accountable for its actions and that that's nothing new, does this new statutory law create, in your opinion, any new risk?
No, it does not.
Excuse me 1 second, Judge. And panel, isn't it correct that this company has always had to follow the public service law?
Yes, that's true.
Now, there was also a lot of questions regarding your risk assessment of individual changes that are affecting possibly the company. Do you have an opinion on that?
Yes, I do. When I look at the company's risk, I look at the risk in its entirety. I don't look at these individual reconciliations that may have a minor effect on the company's overall risk.
And how is that different versus any other rate case that you work on in your work as an employee of the Department of Public Service?
It's not different. I look at the entire risk profile of each company and I make an assessment from there.
Thank you. DPS has nothing further.
Okay. Thank you. This panel is excused. DPS staff, call your next witness, please.
Thank you, Your Honor. At this time, staff calls Mr. Craig Henry.
Raise your right hand for me, please. Do you swear or affirm that the testimony you are about to give will be the truth, the whole truth, and nothing but the truth?
Yes.
And further, do you adopt the pre-filed testimony as your sworn testimony in this proceeding?
As corrected?
As
Yes.
Thank you.
Thank you, Your Honor. Mr. Henry, as you just noted, do you have corrected testimony?
Yes.
And what is that?
I had a correction to exhibit CEH1, and a lot of the testimony that referred to that exhibit I need to make some corrections to that. That's the primary reason for changes, and there was a sentence in my initial testimony, my pre-filed testimony, that I deleted.
Could you put the microphone closer or move over to the other ones?
The light's not working, it's tapping.
That's good.
And at this time, Your Honors, the witness is available for cross. Thank you.
Now, the corrections you just mentioned, were those the ones that were filed with the secretary within the last week or so?
Yes, they were, Judge.
Okay.
Both the exhibits as well as the testimony.
Okay, you are you. It's your turn. I've got you down for 10 minutes.
Thank you, Your Honor. I'm hoping it will not take 10 minutes.
So am I.
Good afternoon, Mr. Henry.
Good afternoon.
My questions pertain to your rebuttal testimony, specifically pages 5 through 8. And there you discuss your reasons for concluding on page 1, lines 18 through 24, that the commission should not adopt Mr. Copeland's proposal that the commission cease using Merrill Lynch's quantitative profiles to produce an estimate of the market risk premium, or MRP, for the capital asset pricing model. Are you familiar with that portion of your testimony?
Yes.
Now, on page 6, you express your opinion starting at line 20. Irrespective of my concerns with using an expected MRP in general, I have found that Merrill Lynch's estimated market returns, while perhaps somewhat slow to react, nonetheless do appear to move in a consistent manner with respect to such market barometers as volatility and yield spreads in the credit markets, and thus have generally produced consistent results over time. That's your testimony, correct?
Yes.
I'd like to hand you a document. It's a one-page document. On the upper left-hand side, it says Bank of America, Merrill Lynch, 12th February 2013. And on top, it says quantitative profiles. I would ask that it be marked for identification. Would that be exhibit 32?
This will be 783 for identification.
783?
783.
Mr. Henry, would you agree that this is a page from the February 2013 edition of Merrill Lynch's quantitative profiles that you used in developing the market risk premium? It's part of, it's included the work papers that you used in preparation of exhibit CDH2?
It appears to be.
Do you see at the top of the page and the valuation backdrop, a chart labeled S&P 500 risk premium.
Yes, I see that.
And would you agree that from 2009 to 2013, the general trend in the S&P risk premium estimated by Merrill Lynch has been generally upward?
It appears to be, actually, from 2009 through 2011, it appears to be going down. It has another little blip, and then for the past, it looks like the past year, generally upward.
Okay. And then if you go back further to 2003, you would say that in general it's been a rise between 2003 and 2013, an overall trend.
If you were plotting a trend line, it looks like a generally upward trend.
Okay, now I'd like to hand you, for reference, a copy of Mr. Copeland's testimony, page 48. On the bottom of that page, do you see a chart of an index known as the VIX, which measures the volatility of the S&P 500?
I see that.
Okay. And I guess by definition, the market volatility index measures the volatility of the S&P 500. Is that not correct?
I believe that's generally the case.
Okay. So from a peak of over 70 in late 2008, the VIX has declined to between 20 and 10 in 2013, has it not?
Well, historically, the VIX has been averaged about 20.9, and I would say that in terms of characterizing the VIX, or VIX as you're referring to it, it entered the financial crisis time frame there, where it was in the low mid-teens. In 2008, it ended the year up in the 60s, and generally since then it's been trending back downward with another little, it was elevated again in 2010, elevated again in 2011, 2012, not a whole lot of upward pressure. It's, in fact, I would say for the past year, the volatility has been lower than its historic average.
Okay, so given the general trend in the VIX between January of 2012 and currently, would you not expect the market risk premium to be lower in 2013?
I would expect the market risk premium to begin declining. As I stated, what I've seen is the Merrill Lynch model may be a little slow to react to these sort of things, but it does react over time. So there may be a lag associated with it, but generally speaking, in my experience, it's Merrill Lynch seems to provide a reasonably consistent, produce reasonably consistent results when you see with things that are going on elsewhere, especially this very low interest rate environment. It wouldn't be that surprising with the Fed holding, especially short-term rates down, but also influencing the long-term rates to a certain extent, that you might see a larger than certainly what you may have seen in the mid-2000s in terms of how big the market risk premium on a forward basis would be.
So I wanted to explore with you, when you say that the Merrill Lynch risk premium is slow to react, do you have any sense of Is that in terms of months or years when you say
Well,
slow
you know,
react?
it's sort of a bottom-up approach where they're calculating also the estimates on all 500 companies in the index, and some of the individual analysts may my view, it may take them a little bit of time to digest, where the market's at and where things are headed, but as I suspect that, and actually, I've seen Merrill Lynch's estimate of the market is certainly since March. We were at 12. March and April, we were at 12.2. I believe the latest it's down to 12. So they're moving in the right direction in terms of where I would expect it to go.
Okay, but in terms of the length of time, are you saying it might take a year to react or longer?
I have no idea. I'm suggesting to you that my belief is that Merrill Lynch's estimated market return, especially as the market reaches heights, keeps on. It's well over 1,600. The S&P 500. As the market begins to discount future growth, you're going to see Merrill's estimate of the market return tend to go down. And together with the fact that some of the interest rates, which are arguably somewhat artificially low, that's also creating a larger than what you might expect otherwise market risk premium.
Okay, you can just turn to the top of page 6, lines 3 through 8, and there you say, "I'm well aware that many studies have been published in MRP, and it is expressly because I found those studies to produce such disparate results that I acknowledge my own concern with the CAPM methodology in my direct testimony." Now, are you aware of any published studies on the MRP showing that the risk premium has risen nearly 500 basis points since 2011?
I'm not specifically aware of any reports that are stating that the belief that the market risk premium has gone up as you described.
Would you agree that investment firms which estimate expected returns use much lower estimates of the market risk premium than what you derive using Merrill Lynch?
I'm not aware what I believe you described CFOs for companies, or what is that what you're saying?
Well, let me show you the document that helped clarify my question regarding one of the investment firms that you relied upon for your testimony. This is a document taken from page 38 of 116 of Mr. Henry's Exhibit 14. It appears that this is taken from a UBS investment research publication, the July 20th, 2012 edition of U.S. Electric Utilities. Is that correct?
July 12th, 2010, but yes.
And if you look at the bottom paragraph of that document, what estimate of the market risk premium does UBS use in its valuation of Consolidated Edison stock?
It says a 6% market risk premium.
Thank you. That's all the questions I have here.
Mr. Carly?
Thank you. Mr. Henry, in your direct testimony, you recommended a return on equity for the company of 8.7%, isn't that correct?
Yes.
I'm handing out, Your Honor, a 3-page document, which is essentially an update to part of the company's response to County of Westchester interrogatory COW-18. And what this 3-page document shows is, and it's based upon information provided by S&L Financial, it includes information relating to electric rate case decisions issued from January 2011 through July of this year. The cases are listed chronologically. The most recent ones are at the top of page 1. And I would ask that this 3-page document be marked as an exhibit.
It'll be marked as Exhibit 784 for identification.
Mr. Henry, in reviewing this document, I would ask that you pay particular attention to towards the right-hand side of each of the 3 pages. There is a tab which says Increased Authorized, and there is a column underneath that, actually 2 columns. One is a column that says Date, which is the date of the decisions issued in each of these cases. And also there's a column, Return on Equity, which indicates the return on equity which was granted in each of these cases. And in looking over those columns on these 3 pages, I would ask you whether or not it's true that whether there's any return on equity granted that is below 9%.
I don't believe there is.
Thank you. Now, in June of this year, the Commission issued a rate order in case 12G-0544, which involved Brooklyn Union Gas Company doing business as National Grid New York. You involved in that case at all?
No.
Are you familiar with it?
I'm familiar that there was the company had, the 5-year rate plan was about to expire, and there were negotiations and some additional, there was a joint proposal in which that rate plan was extended for, I believe, an additional 2 years.
Have you read the order issued in that case?
No, I've not read the order.
Is it true that the return on equity allowed by the Commission in that case was 9.4%?
I believe that's correct.
And is it also true that the order covered the rate years ending December 31st, 2013, and December 31st, 2014?
If I can check that, I'd be happy to answer that.
So the answer is yes.
Yes.
Judge, I think just the record needs a little clarification as to what just happened. If counsel could explain what was just handed to Mr. Henry.
Oh, it would be my pleasure. I certainly want the record to be clear. I handed Mr. Henry the Commission's order in the Brooklyn Union Gas Company case that was issued June 13th, 2013. And based upon Mr. Henry's review of that order, he was able to indeed confirm that...
Judge, I think the record reflects what Mr. Henry stated as a result of observing a document that was handed to Mr. Henry. The question was what was handed to him, which was not presented to anyone else.
Okay, but it was only so that he could resolve for himself whether he had to check something or not. And he was satisfied with it, and he's an experienced person, so I don't see a problem here.
No, I agree. I just we need it on the record what happened, because I didn't know what was handed to him, and I didn't think you did either.
May I continue?
All right, questions get directed up here, okay?
I
Yes, you
understand
may
that.
continue.
Thank you. And Mr. Henry, the 9.4% return on equity granted in the Brooklyn Union Gas Company would be 70 basis points higher than the 8.7% ROE that you're recommending in this case?
That would be correct.
And it's also true that the second year of the rate plan in the Brooklyn Union case covers the calendar year ending December 31, 2014, correct?
Correct.
Isn't that the same rate year applicable to the Con Edison electric, gas, and steam rate cases that are subject to these evidentiary hearings?
That's correct.
Does that include some kind of stay-out premium?
It's a joint proposal, so from a multi-year joint proposal, and in my opinion, it reflects various trade-offs. There's, this whatever business risk and financial risk the parties felt was reasonable, and it also would reflect conditions at the time that the joint proposal was consummated.
The New York ones that are on this list, exhibit, this was 784. Are those all multi-year cases?
Most, I'm not sure how far this goes back, but most cases in New York have been resolved through joint proposals. There's not that many instances in which the case is fully litigated. There are a few, of course.
Go ahead, Charlie, sir.
Thank you. On page 21 of your direct testimony, Mr. Henry, you expressed the opinion that retail electric sales growth should not be expected to grow quite as fast as the economy as a whole, since the United States is moving from a manufacturing economy to a service economy. Isn't that correct?
Yes, that's correct.
Isn't it possible that with the increase in the volumes of reasonably priced natural gas, this may lead to a revival of the manufacturing activities in this country?
There's certainly a possibility that could happen, and certainly there may be some. My understanding as far as how manufacturing might develop, it would be quite different than it's been in the past. Far less labor intensive and more dependent upon machinery and such, but obviously I have no idea what types of manufacturing could rebound or come back. I am aware that there's discussion about what could or could not transpire in the future in the energy, the EIA Energy Outlook 2013, which is an exhibit in my testimony.
Even assuming this movement to a service economy, there still will be a demand for electricity, correct?
There will always be a demand for electricity, as far as I know.
For instance, isn't it true that there's been an increase in the number of computer data centers that are large users of electricity?
I don't know that to be personally. I personally can't verify that whether that's the case or not. It seems plausible.
In addition, don't certain experts expect that the electric vehicle industry to become increasingly viable during the next decade?
Again, there is some speculation as to what could happen with that. And again, that's the sort of information that's already been digested by the EIA and their outlook as far as the retail growth.
Your Honor, I'm passing around now a 2-page document which reprints an article from today's New York Post that talks about electric taxis in New York City. And in order to move this along, Mr. Henry, I would just direct your attention to the second page, where it says the city hopes to make 1/3 of its taxi fleet electric by the year 2020. And I just ask you whether indeed that article says as much.
It says the city hopes to make 1/3 of its taxi fleet electric by 2020.
Thank you.
Did you want to mark this?
Yes, that would be helpful.
Are you sure?
I'm very sure. This is a paper record.
It doesn't say how many electric taxis they're planning to have in year 2014.
I'd like it marked as an exhibit, Your Honor. I don't want to have to take it down.
But I love the New York Post as much as anybody, so we'll call this exhibit 785.
This is what, 785?
785. By the way, does anybody know if we have a baby at the
Yes, it's
Prince
a
or
boy.
Princess yet?
I'm scanning Google News earlier because he's stimulating.
Okay, Mr. Crowley, sorry.
Mr. Henry, hasn't the commission established a proceeding, case 13-E-0199, to investigate how the commission can ensure that its regulations and policies promote the continuing evolution of the market for plug-in electric vehicles?
I'm not specifically aware of that case.
And I take it you're familiar with the testimony of the staff capital structure panel in this proceeding. Isn't it true that the panel adopts a traditional staff position, rejecting the use of a standalone capitalization and arguing instead that Sacconi's capitalization should be considered on a consolidated CEI basis?
I can, in my view, that the capital structure panel took the approach that staff takes in every single case where we're examining the reasonableness of a utility's capital structure. We look at the consolidated capital structure of the parent in order to determine whether or not the standalone utility capitalization is reasonable for setting rates.
So you're in agreement with that?
I'm in agreement with their position that we start with a consolidated capital structure in order to ascertain the reasonableness of the standalone. That would be true.
Thank you. On page 60 of your direct testimony, you discussed the appropriateness of including CEI, and that's the parent company of Sacconi, in your proxy group. And in doing so, it's true, isn't it, that you reject Mr. Hebert's position that including CEI in the proxy group is improper since it introduces circular logic into the process, isn't that correct?
Yeah, it's his argument is that it introduces circular logic, and I disagree with that.
Given the staff capital structure panel's position that capitalization should be determined on a consolidated CEI basis rather than a standalone Sacconi basis, isn't CEI very much the subject company in these three rate cases?
The subject company is Sacconi, and we were unable to perform any sort of analysis on its common stock because it's not publicly traded. Its parent is. CEI obviously is a large portion of CEI is Sacconi. We've got some relatively small scale competitive businesses, and you also have Orange and Rockland utilities.
Well, referring to the Form 10Q that one of your colleagues circulated earlier today, on page 9 of that document, I don't know whether you have a copy.
I don't have a copy with me.
It's
770.
770 was just the one page. I was talking about the entire document, which is also. And is it fair to say, you were talking about the relative size of Sacconi versus the other components of CEI, if you will. And it's fair to say that Sacconi, its combined electric, gas, and steam operations are by and large the vast majority of CEI. In fact, I think if you look at the 10Q, the combined electric, gas, and steam net plant represent approximately 26 billion of CEI's combined, approximately 27 billion of net plant. That sounds accurate to you?
You're in the ballpark, sure.
So, Is it fair to say that the effect of a rate case decision regarding Saccone is likely to have a direct effect on the CEI stock price?
I believe that it's going to have an impact on the company's stock price when the commission decides. The investors will certainly make their views known as to whether or not the commission decided the case in a manner in which they anticipated.
Now, one last set of questions. On pages 44 and 45 of your direct testimony, you note that investors' yield requirements have decreased between 2009 and May 2013 due to underlying economic conditions. And you specifically compare the yields for long-term A-rated utility debt, 20-year Treasury securities, and CEI's common stock in 2009, and in May 2013 when you filed the direct testimony. Is that correct?
Yes.
And it's also true, though, that the current yield requirements today have increased since April 2013, haven't they?
Con Edison's yield as of June 2013 was 4.3, and at the end of April it was approximately 3.96. So the yield has increased from April to June.
And that's also the case for the 20-year Treasury securities and the long-term A-rated utility debt?
Yeah, there seems to, at least very recently anyway, there does seem to be a very strong correlation between utility yields and long-term debt yields, very similar types of investors.
No, I have no further questions for this witness.
Thank you. Any redirect?
Consult with the witness. Judge, just one redirect, please. Mr. Henry, after the department filed its testimony in this case, it's direct, are you aware of what happened, if anything, to the stock prices of CEI?
As far as I could tell, there was no discernible reaction vis-a-vis the movement in other utility stocks. I'd say no discernible reaction.
Nothing further. Thank you, judges.
Mr. Carlin. Okay, thank you. Dismissed. That ends the hearings for today. We're going to reconvene tomorrow at 9:30 a.m. Thank you, everyone, for your cooperation.